A lot of people think financial freedom is some big, far-off goal, but the truth is, it can start with something as simple as a $10 a day habit if you're investing it the right way. Over the past few years, I've made dozens of videos showing exactly how to build dividend income step by step with real numbers, real portfolios, and real outcomes. So in this special compilation, I've pulled together the most helpful and most practical moments from 6 of those videos. You'll see how $10 a day can grow into $60,000 a year in dividends, which Dividend Aristocrats are actually beating the market, and how a simple 3 ETF strategy can turn a $10 daily investment into a $1 million portfolio. If you follow closely, you'll start to see a pattern, a clear, repeatable way to make your money work harder than your job ever could. Let's kick it off with the basics. How to invest in dividend stocks for beginners in 2025. How do I start investing in dividend stocks? What exactly are dividends? How much money do I need to begin? Which stocks should I pick and when do I buy them? And most importantly, how do I make sure I'm not making a huge mistake with my money? If you're asking these questions, don't worry, you're not alone. In fact, these are the exact questions I'm going to help you answer in this video. I'm diving into the basics of investing in stocks, breaking down everything from understanding what stocks are to choosing the right investments. Whether you're just starting out or need a refresher, I'll answer your questions about brokerage accounts, stock tickers, market orders, and more. Plus, in the end, I'll show you and John how you can combine everything to create a well-diversified portfolio that can turn your $10 daily investment into a portfolio valued at around $3 million, with $60,000 in annual dividends equating to roughly $5,000 in monthly dividend income. First, let's clarify a few things about investing in dividend stocks, because investing isn't just for Wall Street professionals or billionaires, it's for anyone who wants to take charge of their financial future. Whether you're aiming to save for a house, a vacation, or just a comfortable retirement, investing can help you reach those goals faster than any savings account ever will. The key is to start and keep going. It's all about making your money work for you instead of the other way around. All right, now that I've got your attention, let's get to know stocks. In simple words, stocks are just a way to own a tiny piece of a company. When you buy a stock, or in finance terms, when you invest in a stock, you're not just throwing money into the void, you're actually becoming part owner of a business. Every time they do well, you do well. How? Well, let me explain. A stock is a piece of paper that represents a claim on a company's assets and earnings. When the company does well, whether it's making more money, launching new products, or expanding to new markets, its stock price tends to go up. And when that happens, the value of your little slice increases as well. But stocks aren't a get-rich-quick thing. There's always a little risk involved. The value of a stock can go up, but it can also go down. The key here is that stocks are an investment for the long term. So long as you're patient and keep a steady hand, the market tends to reward those who stay invested. Another thing that can come attached with stocks are dividends. These are called dividend stocks. They're like little bonuses that companies pay out to owners of the stocks. If you own a stock that pays a dividend, you'll receive a payout, typically in cash or sometimes in additional shares. These dividends are usually paid quarterly. So how can you invest in a dividend stock? Well, that's the next thing we're going to cover. I'm going to tell you how you can get started with investing even if you're not exactly swimming in cash right now. The first thing you and John need to start investing is a brokerage account. Think of it like your investment shopping cart. You'll use it to buy and sell stocks just like you would when buying something online. For stocks, I've partnered with Moomoo. It's an app that allows you to trade stocks, options, and ETFs from your laptop, iPad, or your phone. And they don't charge any commission fees, unlike some other brokerages that do.
Moomoo offers powerful free features like financial analysis, market monitoring tools, and conditional orders, helping you spot bullish stocks and potential investment opportunities. New users can earn up to an 8.1% APY on idle funds for 3 months and enjoy a generous welcome bonus, including up to 15 free stocks and a 1.5% cash reward up to a $300 maximum on initial transfers. Sign up using my link in the description, make a deposit, and take advantage of these amazing rewards. Don't miss out on this opportunity to enhance your trading experience with Moomoo. Once your account is set up, you can link it to your bank account and start depositing funds. If everything goes smoothly, you can start with investing as little as $10 a day. And if you choose a stock like Home Depot with consistent investing habits, in 30 years, that initial daily contribution will turn into a massive $3 million portfolio. If you want to know how I got these numbers or how I selected Home Depot as a stock investment, then stick around till the end, because I'm going to tell you and John all about it and along the way, show you similar stocks and a portfolio that can turn your $10 daily investment into a $3 million portfolio. Now, to really make sense of all the stock numbers and terms, you've got to understand how the stock market actually works. First up, let's talk about ticker symbols. These are like the stock's nickname, a short code used to identify a company on the stock market. For example, Home Depot's ticker symbol is HD, and Coca-Cola's is KO. Whenever you search for a stock, you'll see these abbreviations everywhere. It's your way of quickly recognizing a company without having to type out the whole name. Next is market orders versus limit orders. This is a big one. When you buy or sell stocks, you can place either a market order or a limit order, and each has its pros and cons. A market order means you're buying or selling immediately at the current market price. It's fast, it's simple, and it ensures you're in and out quickly. But sometimes you may end up paying a bit more or selling for a bit less than you were expecting. That's just the way the market works. On the other hand, a limit order is where you get to specify the exact price at which you're willing to buy or sell. If the stock hits that price, the order goes through. If it doesn't, well, you can wait, adjust your price, or cancel the order altogether. This gives you more control over the price, but there's no guarantee the trade will execute immediately or at all if the stock price doesn't hit your desired number. Next, let's talk about bid and ask. When you see a stock listed on your broker platform, you'll see two prices, the bid and the ask. The bid is the price that buyers are willing to pay for the stock, while the ask is the price that sellers are asking for. The difference between the two is called the spread, and it can tell you a lot about how liquid or easily tradable a stock is. The tighter the spread, the more liquid the stock. Wider spreads, on the other hand, may indicate less liquidity, meaning the stock isn't being bought or sold as frequently. Stocks of large, well-established companies like Apple or Microsoft usually have high liquidity, meaning there are plenty of buyers and sellers. For smaller or less popular stocks, liquidity can be lower, which might make it harder to enter or exit a position without impacting the price. Which order you use and which company you choose to invest in really depends on your investing strategy, the company's metrics, and a bunch of other factors that I'll break down for you so you can make smarter, more informed choices. Alright, so now that you've got a handle on the basics, let's get to know how you can use all this knowledge for dividend investing. If you're someone who likes the idea of earning money just by owning stocks, then this could be a great strategy for you. Let's take a look at a real-life example to better understand how these market mechanics and market dynamics come together with Hawthorne Bank shares with the ticker symbol HWBK. So this is a small regional bank with a relatively stable market position. Let's say you're interested in buying stock in Hawthorne Bank shares, and you look at the bid and ask prices. Let's say the bid price might be $20.10 and the ask price is $20.15. Just a small spread between them showing decent liquidity. Now, if you want to place a market order, you'll get in at the current market price of $20.12. But if you're looking to save a few cents, you might choose a limit order at $20.05 to wait and see if the stock drops to that price. On top of this, Hawthorne Bank Shares pays a dividend of about 19 cents per share quarterly. So if you owned 100 shares, that's $19 every quarter coming your way, whether you do anything or not. That's the beauty of dividend investing, getting that regular income stream while your investment could still appreciate over time. By understanding these mechanics like ticker symbols, orders, bid-ask prices, and dividends, you're already setting yourself up for smarter investing decisions. And with stocks like Hawthorne Bank Shares, you can see how these concepts play out in real time. Let's say you and John invested $10,000 in this company and reinvested all your dividends. After 30 years, your portfolio could be worth over $1 million. And here's how it could play out. After 1 year, your portfolio would be worth $11,349. After 10 years, your portfolio would be worth $37,657. After 20 years, your portfolio would be worth $171,738. Fast forward to 30 years, and you could be earning more than $100,000 a year in dividends alone, and your portfolio would be worth $1,082,373. I know this stock sounds great, but how do you actually find one like it? Well, it's easier than you might think. To start, you need to understand the different investing strategies, because if you want to win at investing, you've got to have a game plan, and that's what we'll explain next. First things first, you need to match your strategy with your financial goals and risk tolerance. Are you investing for a down payment on a house in 5 years, or are you thinking long-term, like building wealth for retirement in 30 years? The answer to that question will determine how much risk you're willing to take. For example, if you're planning on buying a house soon, you might not want to go all in on super stocks whose prices are very unpredictable. But if you've got a retirement plan, you can afford small investment amounts and stable stocks that over time would compound your wealth. And dividend stocks are actually ideal for this strategy. A common strategy is to diversify your investments. This means you don't put all your money into one stock, which helps spread out the risk. You might have some stocks, some bonds, and maybe even some real estate investments. Diversification is basically choosing not to put all of your eggs into one basket. Because if one egg cracks, don't worry, you've got others to fall back on. Now, when you're just starting out, you might feel a little overwhelmed by all the different strategies. That's totally normal. The good news is, you don't have to be perfect. One simple strategy you can try is dollar cost averaging. This is where you invest a fixed amount of money, let's say $10 a day, regardless of what the market is doing. It takes the emotion out of investing and helps you avoid trying to time the market, which is really hard to do successfully. So whether the stock price is high or low, you are investing the same amount. Over time, this can help you buy more shares when prices are lower and fewer when they're high, leading to a lower average cost per share. I should point out, one of the biggest misconceptions about dividend investing is that it's only for retirees or people who need income right away. Not true. Dividends can benefit investors of all ages, not just retirees. Think about it, dividends are a great way to grow your wealth automatically over time. When you reinvest your dividends, you're buying more shares without having to do anything extra. This process is known as dividend reinvestment, or DRIP, and it can supercharge your returns. Before we dive into specific investing strategies in detail, it's important to remember there's no one-size-fits-all approach. Your strategy should reflect your goals, your risk tolerance, and your investment horizon. With a solid strategy in place, you'll feel a lot more confident in your ability to navigate the ups and downs of the market. To make it easy for you, I've already handpicked a portfolio of stocks. In the end, I'll reveal this portfolio, which can turn a $10 daily investment into a $3 million portfolio valuation that'll pay $5,000 in monthly dividend income. Now, if you're not a fan of hassle, then you can just follow the best in the investing world, Warren Buffett. He's probably the most famous investor in the world, and he made his fortune by following the principles of value investing. Buffett bought $1 billion worth of Coca-Cola stock back in 1988. Over time, the dividends from Coca-Cola have been reinvested, growing his wealth exponentially to $25 billion. And today, it continues to pay him massive dividends of close to $1 billion every year. Warren Buffett's strategy is all about buying high-quality, dividend-paying companies and holding on to them for the long term. Simply put, value investing is about buying stocks that are currently undervalued by the market. The key to value investing is patience. You're not looking for a quick flip unless you're trying to day trade, which can be risky. You're looking for companies that are trading below their true worth. These are companies that have solid fundamentals but are temporarily undervalued for one reason or another. Maybe the market has overlooked them, or there's some short-term issue that'll eventually pass. But how do you find these diamonds in the rough? The first step is to understand the business behind the stock. After all, you wouldn't buy a car without looking under the hood, right? Well, investing in a business is pretty much the same thing. You need to research the company's revenue streams, profitability, and overall long-term sustainability. This ensures you're not just betting on a stock price, you're investing in a real working business. Start by taking a deep dive into how the company makes its money. Is it relying on just one product or service, or does it have a diverse set of revenue streams? Take Apple, for example. Their iPhones are a massive resource of revenue, but they also make money through services like iCloud, the App Store, and Apple Music. This diversification can be a safety net if one part of the business takes a hit. Similarly, Tesla has multiple revenue streams tied to its cars, energy products, and even regulatory credits. Understanding how these revenue streams contribute to a company's profits helps you analyze its financial health and growth potential. Next, look at the profitability of the business. Is it consistently turning a profit, or is it in the red? Check out the income statement for key figures like gross profit, operating income, and net income. For example, Tesla's net income has been growing steadily, indicating that it is successfully scaling its operations and reaching profitability. But even a company with high revenue might have poor profitability due to high costs, so look beyond the top line and dig deeper. Another thing to keep in mind is the business's competitive edge. Does the company have a unique product, service, or market position that others can't easily replicate? Take Apple again. It's not just about the products, but brand loyalty and the ecosystem they've built. People don't just buy Apple because it's a phone, they buy it because of the entire Apple experience. Understanding these advantages will help you access whether a company can maintain its dominance in the future. When researching a company, don't forget to also check out real-life case studies of successful businesses. Look at how companies like Apple, Tesla, or Amazon built their businesses and managed their challenges along the way. Those examples can give you a lot of insights into the decision-making and strategies that have worked for big players in the market. The last step in value investing is buying at the right price, which means ensuring you're not overpaying for a stock, even if it's a great company. Let's break this down with some numbers. Let's say a stock is trading at $50 per share, and the company's annual earnings per share, EPS, are $5. The price-to-earnings ratio in this case is calculated as $50 divided by $5, which equals 10. This tells you that investors are willing to pay $10 for every $1 of the company's earnings. To determine if the stock is undervalued, you compare this with the industry average PE ratio. If the industry average is 15, the stock might be undervalued. However, if the industry average is, say, 8, this stock could be overvalued unless there are compelling reasons to believe it has exceptional growth potential. Another key metric is the price-to-book ratio, PB ratio, which compares the stock price to the company's net assets, total assets minus liabilities. Let's say the company's total book value is $1 billion and there are 20 million shares outstanding. The book value per share would be $1 billion divided by 20 million, which equals $50. If the stock is also trading at $50, the PB ratio is $50 divided by $50, which equals 1, meaning you're paying exactly what the company's net assets are worth. A PB ratio below 1 would indicate you're buying the stock at a discount relative to its assets. Combining these insights, if a stock has a PE ratio of 10 below the industry average of 15 and a PB ratio of 1 fairly valued by assets, and you believe in its long-term growth potential, then this could signal a good buying opportunity. By analyzing these metrics, you can make informed decisions and ensure you're not overpaying even for a fundamentally strong company. As you can see, value investing is more of a hands-on experience. Next, we'll cover a strategy that's more of a hands-off experience requiring less effort on your part. Passive investing, a strategy that's become incredibly popular in recent years because it's simple, low cost, and effective. Passive investing involves buying investments that track the overall market or specific sectors rather than trying to pick individual stocks. The idea is that over time, the market will generally rise, and by investing in a broad range of assets, you'll get solid returns without the need to constantly buy and sell individual stocks. The easiest way to get started with passive investing is through index funds and exchange-traded funds, also known as ETFs. These are types of investment funds that track specific market indexes, such as the S&P 500, which includes 500 of the largest companies in the U.S., the Dow Jones Industrial Average, which tracks 30 major U.S. companies, or the Nasdaq Composite, which focuses on technology-heavy companies. There are also international indexes like the FTSE 100, which tracks the top 100 companies listed on the London Stock Exchange, and the MSCI Emerging Markets Index, which covers companies in developing countries. When you invest in an index fund or ETF, you're essentially buying a small piece of each company included in that index. For example, an S&P 500 index fund gives you exposure to a wide range of industries, from tech giants like Apple to consumer staples like Procter & Gamble. This approach offers the easiest way to diversify your portfolio without the need to pick individual stocks, reducing risk while still participating in the market's growth. Whether you want exposure to the broader market, specific industries, or even international markets, there's an index fund or ETF out there that fits your needs. One of the big advantages of passive investing is the low fees. Unlike actively managed funds, which have higher management fees because they're constantly buying and selling stocks, index funds and ETFs usually have lower fees since they're just tracking the market. Over the long term, these savings can add up and really boost your returns. Let's look at an example of an ETF, like the ProShares Ultra Pro Dow 30 with the ticker symbol UDOW. This ETF tracks the performance of the Dow Jones Industrial Average, which is made up of 30 major U.S. companies. The beauty of investing in this ETF is that it gives you exposure to all 30 companies without you having to individually pick and manage each of those stocks. Here's how this ETF could grow your and John's money over the long haul, assuming you start with a $10,000 investment and reinvest your dividends. This ETF has a dividend yield of 0.79%, meaning you'd earn around $79 in dividends in the first year if you started with $10,000. Over time, as the share price increases by an average of 20.41% annually, your investment grows not just from dividends, but also from capital appreciation. Plus, with a 10-year dividend CAGR of 27.63%, the dividends you earn will grow significantly each year, giving you more and more to reinvest. I'll dive deeper into how this works and the power of reinvestment later in the video, but for now, just take a look how the passive strategy could lead to massive returns over time. After 1 year, your portfolio would be worth $12,120. After 10 years, your investment could grow to about $70,181. After 20 years, you might be sitting on around $539,467. And after 30 years, your investment could be worth a massive $4.96 million. So why should you consider passive investing? Because it's simple, effective, and low maintenance. It's a great option if you don't want to spend your time picking stocks or following the market every day. By investing in index funds and ETFs, you can achieve solid long-term growth without needing to be an expert. It's a fantastic strategy for beginners or anyone who wants to build wealth while keeping things as low stress as possible. Now, some of you might want a little risk in exchange for potentially big rewards. For that, the best strategy is known as growth investing. This strategy is all about finding companies that are growing fast and have the potential for explosive gains. The idea is that you're not looking for a quick paycheck in the form of dividends. Instead, you're hoping that your investment will appreciate in value as the company grows, often at a much higher rate than the market average. Think of it as betting on the next big thing before it hits the mainstream. But it comes with higher risk because the companies you're investing in may not have a long track record or a stable revenue stream. These companies are usually in the booming phase of their business cycle. While some of these companies may skyrocket, others could fall. So it's definitely a higher risk, higher reward game. But how do you find the right growth stocks? Well, first you want to look for companies that are growing their revenues and profits rapidly. These companies often reinvest their profits back into the business to fuel further growth, which means they may not pay dividends. That's okay though. Your reward comes from the increase in the stock price over time. Next, look for companies in industries with high growth potential, like artificial intelligence, clean energy, or e-commerce. Let's take a look at a real-world example of growth investing with Visa Incorporated. Over the past few decades, Visa has been one of the top-performing growth stocks thanks to the explosion in digital payments. And if you would invest in Visa today, your $10,000 investment could grow to over $1.4 million. That's the power of growth investing. Find a company with solid growth potential, then let the market work its magic. Now, don't expect these kinds of returns every year, and certainly don't expect them to come without some ups and downs along the way. Growth stocks can be volatile, and there will likely be periods where the stock price fluctuates. That's why growth investing is better suited for those with a long-term outlook. You need to be patient and willing to hold on to your stocks even when the market gets choppy. But if you choose the right companies and ride the waves of the market, growth investing can lead to big-time rewards. So, how do you read the market to make a profit from it? Well, that's our next stop. Let's dive in. If you've been watching the market, you know one thing is for certain. The market goes up, the market goes down, and sometimes it feels like it's just spinning in circles. This is volatility. But here's the thing, you don't have to shy away from all that movement. In fact, some investors make it work to their advantage. They use the volatility investing strategy, a strategy where investors actually profit from the ups and downs of the market. For sure, volatility investing can sound a little intimidating at first. After all, the market isn't exactly known for being predictable, and sometimes it can be downright unpredictable. However, for investors who understand how to take advantage of these swings, volatility can open up some great opportunities. The key here is to balance risk and reward, knowing when to act on a market dip and when to hold tight through a market rally. One of the most common ways to profit from volatility is by shorting stocks, which involves betting that a stock's price will go down. Here's how it works. You borrow shares of a stock from someone else and sell them at the current price. Later, if the stock price drops, you can buy the same shares back at the lower price, return them to the lender, and keep the difference as profit. For example, if you short a stock at $50 and the price falls to $30, you buy it back for $30, return the shares, and pocket the $20 difference. However, shorting is risky. If the stock price goes up instead of down, you'll lose money because you still have to buy the shares back now at a higher price. For instance, if the stock rises to $70, you'll have to buy it back at $70, losing $20 per share. That's why shorting is considered an advanced strategy and is best suited for experienced investors who understand the risks involved. Another way to profit from market volatility is by riding upward trends. If you can spot a stock that's starting to rally, maybe because of a new product launch or positive earnings, you can jump in and ride the wave for a while. But, just like shorting, riding the wave requires you to stay on top of market news and trends. It's all about being quick and reacting to the market as it moves. The most important part of volatility investing is timing. It's important to recognize market trends and act quickly. But remember, while volatility can offer great opportunities, it can also lead to big losses if you're not careful. That's why it's crucial to manage risk and not put all your eggs in one basket. For those who are comfortable with the risk and have the ability to react quickly, volatility investing can be a powerful way to profit from market swings, but it's not for everyone. If you prefer a more stable, long-term approach, you might want to stick with strategies like value or dividend investing. That's what I do, and that's what I recommend for the majority of investors. Now let's cover how to analyze stocks, ETFs, or mutual funds using key ratios and metrics. When you're evaluating stocks, one of the first things you need to understand is how to analyze the numbers. It's like trying to figure out if your car's engine is in good shape by checking the oil, transmission, and engine light. Except here, you're checking things like PE ratios, dividend yields, and book value. Knowing what these ratios mean can give you valuable insights into a company's health, profitability, and growth potential. Let's start with two related metrics that go hand in hand: price per share, or PPS, and market capitalization, or market cap. Price per share is, of course, the amount you pay to buy a single share of the company's stock. It's a good starting point for evaluating stock prices, but it doesn't tell you the whole story about a company's size or overall value. This is where market cap comes in. Market cap is calculated by multiplying the company's current share price by the number of outstanding shares. It gives you an idea of the company's total market value and helps investors understand the company's size relative to others. Large cap companies like Apple or Microsoft are typically more stable but may grow slower. On the other hand, small cap stocks often offer higher growth potential but come with more risk. For example, Tesla is a large cap company with a high PPS, reflecting its dominant position in the electric vehicle market. Next is price to earnings, or PE ratio. This is a key metric to help determine if a stock is overpriced or underpriced relative to its earnings. A high PE ratio could mean that investors expect high future growth from the company. For example, look at Visa. Its PE ratio is quite high, around 30, reflecting investor confidence in the company's ability to grow. On the other hand, if the PE is low, it could suggest that the market is underestimating the company's future prospects, or maybe the company is facing issues. Another important ratio is the price to book, or PB ratio. This compares a company's market value to its book value, essentially measuring how much you're paying for each dollar of assets the company owns. For example, a PB ratio of 1 means the market values the company at its book value. If it's above 1, you're paying more than the company's asset value, and if it's below 1, you're paying less. For companies like Coca-Cola with a PB of 8.89, you're paying a premium on the assets, but it reflects the strong brand equity and market dominance of Coca-Cola. Next up is the earnings per share, or EPS. This is a key metric that tells you how much profit a company makes for each share of its stock. It's calculated by dividing the company's net earnings by the number of outstanding shares. EPS is important because it shows the profitability of a company on a per-share basis and is often used to compare the profitability of companies within the same industry. A high EPS generally indicates strong profitability, while a low EPS might indicate that the company is struggling. However, you should always compare EPS with other companies in the same sector to get a sense of performance. Another ratio that's part of EPS is dividend yield, a favorite for income investors. This shows you how much money a company returns to shareholders in the form of dividends relative to its stock price. Coca-Cola, with a yield of 0.31%, offers lower immediate returns but is often seen as a stable, reliable company that slowly grows over time. On the other hand, American Tower has a much higher dividend yield at 3.14%, making it a more attractive choice for those seeking passive income. But here's the thing, ratios alone don't tell you everything. You also need to look at a company's balance sheet and income statement to get a complete picture. Take a look at Home Depot's balance sheet. They've got a hefty debt load with $64.13 billion in total debt, but their revenue is sky high, sitting at $154.6 billion. That's where ratios like debt to equity and current ratio come into play, helping you figure out whether the company is over-leveraged or managing their debt well. In the end, these ratios are just tools to help you understand how a company stacks up to the rest of the market. You'll want to use them in combination with your other research, such as understanding the company's industry, competitors, and future growth plans. You've got to look at all the pieces to get the full picture. Now, for my projections, which I showed you earlier, I prefer 3 key metrics: dividend yield, 10-year annual share price average, and 10-year dividend CAGR, or compounded annual growth rate. The 10-year average annual share price appreciation measures how much a stock's price has changed on average per year over the past 10 years. While this metric focuses on capital gains, it's important to look at it in combination with dividends, as it shows how well the stock has performed in terms of total return. 10-year dividend CAGR tells you how much the company has increased its dividend on average each year over the past 10 years. A high dividend CAGR means the company is growing its dividend at a healthy rate, signaling a commitment to returning value to shareholders. So yes, studying a company in depth is good, but you also need to know where it comes from, meaning which sector of the economy is it from? Understanding how these sectors work and how they relate to the broader economy is like knowing all the different types of fruit in the produce section. Some are seasonal, some are staples, and some may be better for your health at different times. Each sector behaves differently depending on the economic climate, so knowing what's inside each one can help you make smarter decisions about where to put your money. There are 11 major economic sectors in the U.S., and each one plays a different role in driving economic growth. For example, the technology sector includes companies that focus on innovation, like Apple or Microsoft. This sector often performs well when the economy is growing, and businesses and consumers are eager to invest in new technologies. On the flip side, the utilities sector, which includes companies like NextEra Energy, is more stable, offering essential services like electricity and water. When the economy slows down, people still need their utilities, making this sector a safe bet for some investors. Consumer discretionary is another interesting sector, which includes companies that produce non-essential goods and services like Nike or Tesla. These companies tend to do well when the economy is thriving and people have extra money to spend on luxury items. On the other hand, consumer staples like Procter & Gamble or Coca-Cola provide essential products like food and cleaning supplies that people continue to buy no matter how the economy is doing. This makes them more stable and less impacted by economic cycles. Then there's the healthcare sector, which includes pharmaceutical companies, hospitals, and health insurance providers. The demand for healthcare is relatively rigid, meaning people will continue to spend money on medical care regardless of the economic climate. In fact, the healthcare sector has been growing rapidly, especially with an aging population and new innovations in treatments and technologies. But just like shopping for fruit, where you want to buy a mix of produce for the different tastes and benefits of each fruit, you need to diversify your investments across different sectors. It's all about risk management. If one sector is underperforming, another might be thriving. For example, while the financial sector might take a hit in a recession, the energy sector could be doing well, especially with the increasing demand for renewable energy. The key takeaway here is that understanding economic sectors helps you understand the bigger picture. You'll be able to spot trends, manage risks, and diversify your portfolio with purpose. So before jumping into any stock, always ask yourself, which sector does it belong to? How might this sector perform given current and future economic conditions? These answers will guide your decisions, and hopefully, you can plan for market volatility. Now, if you're a little confused with all this information, don't worry. I've got you covered. Later on, I'll show you and John a portfolio that will do all this tedious work for you and demonstrate how to convert a $10 daily investment into a $3 million portfolio that pays around $60,000 in annual dividends. So with the right plan in place, you just need to know where to invest. Then you can ride out the rough times and even profit from them. Because markets don't just go up forever. Eventually, there will be corrections, recessions, and bear markets. But here's the thing, they are temporary. The market tends to recover over time. That's why long-term investing is so powerful. If you can weather the storm, you'll be well positioned to benefit when the market swings back in your favor. It's not about predicting the next big dip, it's about staying consistent and sticking to your plan. Staying rational during market highs and lows is crucial. When the market is soaring, it's easy to get caught up in the excitement and fear of missing out, but remember, markets can't rise forever. The same goes for when things look grim. Don't panic and sell off your investments just because everyone else is doing it. Keep your emotions in check. You don't want to buy high and sell low. Developing a long-term plan for different market conditions is one of the best ways to stay calm during volatile times. Make sure your portfolio is diversified, so if one sector or stock drops, others can pick up the slack. For example, if you have a mix of growth stocks, dividend stocks, and bonds, the volatility of any single investment won't have as big an impact on your overall portfolio. Plus, regular contributions to your portfolio, like through dollar-cost averaging, can help smooth out the effects of market swings. When the market is down, you're buying more shares at a lower price, which helps when the market rebounds. It's not just emotions that you have to keep in check, you also have to make the right decisions when faced with a ton of information. This is often called analysis paralysis, and it's something that can really hold you back from making progress in your investment journey. If you've spent hours reading up on stocks, strategies, and data points but never really hit the buy button, listen, you're not alone. But here's the thing, overthinking it can harm your investing journey. The truth is, perfect knowledge doesn't exist. No matter how much research you do, there will always be an element of risk involved in investing. So how do you get past the paralysis? Start small. You don't need to make the perfect decision right away. In fact, you probably won't make perfect decisions in the beginning, and that's okay. The important thing is to take that first step. Start by investing a small amount, learn from the experience, and build confidence. As you gain experience, you'll start to see patterns, learn how markets behave, and develop a gut feeling for what works for you. Building confidence through small, consistent steps is the key. Just like when you're working on your fitness, starting with lighter weights and gradually increasing the intensity helps you build strength over time. The same goes for investing. Starting with small amounts allows you to get comfortable with the process and learn to handle the market's ups and downs without feeling overwhelmed. As you go along, your confidence will grow, and so will your understanding of how it all works. Another thing, consistency over perfection. You might feel like you need to pick the perfect stock or time the market perfectly, but that's just not realistic. What's more important is staying consistent with your contributions. Whether you're adding $10 or $50, consistently investing over time will yield better results than trying to time the market or waiting for the perfect opportunity. Remember, it's easy to get overwhelmed with all the information out there, but doing something is better than doing nothing. Investing is a learning process, and the best way to overcome analysis paralysis is by taking that first step, making mistakes along the way, and learning as you go. You're building wealth for the long term, and every small decision adds up. Once everything is clear for you, from stocks to sectors, then it's time to step up your game. If you're ready to get more serious about growing your wealth, there are some advanced strategies that can really make your money work harder for you. One is reinvesting dividends, which is one of the most powerful tools for compounding returns. Instead of cashing out your dividend payments, you instead use that money to buy more shares of the stock. Over time, this has a snowball effect where your dividends earn more dividends and your investment grows exponentially. Let's break it down with an easy example. Let's say you make an initial investment of $10,000 in a stock that pays a 5% annual dividend. That means in the first year, you'll earn $500 in dividends. Instead of taking the $500 in cash, you instead reinvest it to buy more shares of the stock. Let's say the stock price is $50 per share. With your $500 dividend, you can buy 10 more shares of the stock. Now, in the next year, your dividend is calculated on your larger number of shares. If you started with 200 shares, $10,000 divided by $50, and added 10 more shares through reinvestment, well, you now own 210 shares. The stock still pays a 5% dividend, but now it's based on 210 shares, giving you $525 in dividends instead of $500. You reinvest that $525, buy more shares, and repeat the process. Each year, the number of shares you own keeps growing, which means your dividends grow too. Over time, this compounding effect can significantly increase the value of your investment. After 10 years, your $10,000 investment could grow to over $16,000 just from dividend reinvestments, even without any additional money being added. This is how compounding works. Your money makes more money, and that extra money makes even more money, all while you sit back and let the process do the work. Another advanced tip is to stay informed with market news and trends. The market is always changing, and staying up to date on news, earnings reports, and shifts in market conditions is critical to making informed decisions. But remember, don't get swept away by short-term news or market hysteria. Sure, news can affect stock prices in the short run, but the real value lies in long-term trends. So use your knowledge to adjust your strategy when necessary, but stay committed to your long-term goals. Let's say you've been investing in REITs, real estate investment trusts, ETFs, and individual stocks. By monitoring the market closely and making strategic adjustments, whether that means reallocating your portfolio or finding new opportunities, you can position yourself to build wealth steadily over time. But consistency is the name of the game. As you keep learning, applying these strategies, and staying informed, you'll feel more confident in navigating the ups and downs of the market and see your wealth grow in the process. While staying consistent is important, you don't have to do it alone. In today's fast-paced world, technology can be your best friend when it comes to investing. Thanks to technology, there are plenty of tools and platforms that make investing easier and more accessible. Whether you're a beginner or a seasoned pro, these tools can help you research, track, and manage your investments. Let's take a closer look at a few of them. First off, let's talk about Seeking Alpha. This online platform is one of the most popular free resources out there for tracking stock prices, reading news, and analyzing financial statements. You can create custom watch lists to monitor the stocks you're interested in and get real-time price updates. It also offers tools to dive into the details like company financials, historical performance, and even analyst ratings. Now, with all this talk about strategies and investments, the big question is, what can you and John earn from all of this? Let's take a look at how a portfolio built from everything we've discussed so far could possibly perform. Based on everything we've applied, I've selected the following 5 stocks and combined them into a single portfolio. Let's break down the stocks in the portfolio and their performance metrics. The portfolio includes companies like Coca-Cola, which has a solid forward dividend yield of 1.98% and an impressive dividend growth at 14.87%. The ProShares S&P 500 Dividend Aristocrats ETF provides a solid yield of 1.96% with a dividend growth rate of 11.78%, while also giving you exposure to blue-chip stocks known for stability. American Tower Corporation offers a high yield of 3.1% and a solid growth rate of 17.48%. Other stocks in the mix, like NetEase and the Home Depot, combine good yields and strong capital appreciation, rounding out a balanced portfolio designed to grow steadily over time. Looking at the projection of the portfolio over the next 30 years, we can see how these investments could perform. Starting with a $10,000 initial investment and adding $2,000 annually, here's how the portfolio might grow. After 1 year, your investment would be $3,600 from daily contributions. After 10 years, the portfolio will be valued at around $84,505. After 20 years, you'll be looking at $526,384 in total value. And after 30 years, the portfolio will be valued at $2,843,896. Paying around $59,970 in annual dividends, or about $4,998 in monthly dividend income. The total value added to your portfolio will be around $2,735,896, with $2,359,877 coming from capital appreciation and $376,019 from reinvested dividends. All that from just a $10 daily contribution. Here's a quick summary of what we've covered so far and how it all adds up over time. Investing doesn't need to be complicated or require a fortune to start. In this video, I've simplified how you can invest in stocks and build wealth even if you're a beginner. I've covered the basics like stock tickers, market orders, and dividends so you can make smarter decisions and start investing with confidence. We talked about different investing strategies: value investing, passive investing, and growth investing, and real-life stocks with projections. We also discussed volatility investing, where you can profit from the market ups and downs, but at the same time, you've got to be prepared for quick decisions and risk. Key ratios and metrics help you evaluate stocks, and understanding sectors is key for diversification. Finally, I combined all these strategies into one portfolio and saw how even a $10 per day strategy can grow to a $2.8 million portfolio that pays better than most monthly jobs. Ranking every Dividend Aristocrat from worst to best. There are close to 90 companies on the Dividend Aristocrat list, but how do you know which ones will actually give you the best returns? Sure, many of these companies have been paying dividends for decades, but not all of them are as good as they seem. Some are underperforming and barely move the needle for your portfolio. Others may look good on paper, but aren't built for today's market. So how do you separate the winners from the losers? In this video, I'm ranking every Dividend Aristocrat from worst to best, breaking them down by dividend yield, growth, and overall investment potential. I'll show you and John the underperformers, steady dividend stocks, dividend growth with high appreciation, and in the end, I'll show you high-growth aristocrats that on average increased their share prices by over 20% each year for the last decade. Now, before we get into the rankings, let me quickly walk you through how this video is set up. You've probably heard the term Dividend Aristocrat before. These are companies that have a proven track record of not only paying dividends consistently, but also increasing them year after year for at least 25 consecutive years. But here's the thing, not all Dividend Aristocrats are the same. While many of these companies are known for their reliability and steady income, others have experienced impressive share price growth over the past decade. To give you a clearer picture, I've grouped all the Dividend Aristocrats into categories based on two key factors: dividend yield and 10-year share price growth. Some of these companies are perfect if you're looking for a solid income stream, while others have the potential for explosive growth, and some not so much in either of those categories. Here's a breakdown of how this video will unfold. We'll start with the underperformers, stocks with a dividend yield of less than 4% and weak or negative share price growth. While these companies have struggled over the past decade, they still offer insights into what to avoid in the market.
Next, we'll look at stocks that offer 2% to 4% dividend yields with modest share price growth, 2% to 5% over the last 10 years. These stocks provide steady income, but their share price growth isn't explosive. They might be more suited for conservative investors. In the moderate performers category, we'll examine stocks with 2% to 3% dividends and 5% to 10% share appreciation. These companies have shown consistent performance over time, providing a middle ground option for investors seeking both income and growth. Then we'll move to stable growth with modest yield stocks, those with 1% to 2% dividend yields and 5% to 10% share price appreciation. These companies have a solid track record of growth and stability, making them appealing to long-term investors who value reliability. Then there's the stable income category, focusing on stocks offering 3% or higher dividends and consistent growth of 2 to 5% annually. For those seeking high dividends but are willing to accept minimal or negative share price growth, we'll discuss high-yield, low-growth stocks. These companies offer returns primarily through dividends, less than 4%, but their share prices have remained stagnant or even declined. Next, I'll show you the dividend growth with high appreciation category, companies offering 2% to 3% dividend yields with over 10% share price growth in the past decade. These stocks combine both steady dividend growth and impressive share price appreciation, making them ideal for investors who want a mix of income and capital gains. Finally, we'll rank the high growth category, where you'll see stocks with less than 2% dividend yields but exceptional share price growth, 10 to 20% and more. These companies are at the forefront of innovation, and their rapid growth makes them perfect for investors looking for explosive returns and willing to sacrifice dividends for higher potential gains. Throughout this video, I'll highlight some standout companies from each category, discuss their strengths, and show you why these stocks have been outperforming their peers. By the end, you'll have a clear idea of which Dividend Aristocrats deserve a spot in your portfolio. So let's start with the first category, which is the underperformers. These are companies that offer a dividend yield below 4%, but over the past 10 years, their share price growth has either been under 2% or even negative. Now, it might sound like a good deal to get these stocks for their long history of dividend payments, but the truth is that their slow or sometimes shrinking growth could end up hurting your portfolio over time. Sure, you'll be getting those steady dividend payments, but when the stock price isn't growing, it means your investment isn't doing much to build wealth. One company that falls into this category is Wiley, along with its sibling stock Wiley B. Both of these offer a 3.44% dividend yield and have been increasing their dividends for 26 consecutive years. Sounds pretty good, right? But here's the catch. Over the past decade, Wiley's share price on average each year dropped by 4.16%. And Wiley B didn't do any better, with a 4.14% yearly drop. So while you're collecting a steady dividend, the company's value is eroding. This makes it tough for your overall portfolio to grow. So unless you're only focused on dividends and don't care about capital appreciation, Wiley might not be the best pick for you. Next up is Stanley Black & Decker, a name you probably recognize in the tools and home improvement industry. This company has been growing its dividend for 56 years straight, which is incredibly impressive. With a dividend yield of 3.72%, it seems like a solid income stock on paper, but here's the issue. Over the last 10 years, its share price has actually dropped by an average of 0.91% each year. For a company that's in an industry where demand is usually pretty steady, this lack of growth is concerning. While the dividend is nice, the lack of share price growth means your overall investment isn't keeping up with inflation, let alone growing. Stanley Black & Decker might be reliable when it comes to tools, but as an investment, it's falling short. Now, you'd expect a big name like ExxonMobil to be a strong performer, but it actually lands in the underperformers category as well. Exxon has a 3.71% dividend yield and has been growing its dividends for 42 years. But despite its size and history, the company's share price has only grown by an average of 1.48% over the last decade. This slow growth is surprising considering the global demand for energy. However, Exxon has faced challenges with fluctuating oil prices and increasing pressure to move toward renewable energy. While the dividend is attractive, the sluggish share price growth might make you think twice before adding Exxon to your portfolio. Another disappointing performer is Matthews International Corporation. It has a 3.57% dividend yield and has grown its dividends for 26 years, but the share price tells a different story. Over the past 10 years, Matthews stock has dropped by 5.27% on average each year. That's a significant decline, especially for a company that's supposed to be a dividend aristocrat. The company operates in industries like memorialization and industrial technologies, which don't always offer the same growth opportunities as other sectors. While the dividends are consistent, the declining stock value would eat into your overall returns, making Matthews a risky pick for long-term investors. Next up in the underperformer category is Genuine Parts Company, a company known for auto parts and industrial products. It offers a 3.44% dividend yield and has an incredible 68-year streak of dividend growth. But despite this long history, the company's share price has only grown 1.73% on average each year over the past 10 years. While Genuine Parts provides steady income, its lack of share appreciation limits its appeal for investors who want their portfolios to grow over time. It's a good option if you're focused solely on dividends, but don't expect your investment to multiply anytime soon. Kimberly-Clark, the company behind household names like Kleenex and Huggies, falls into the same boat. It has a solid 3.88% dividend yield and 52 years of dividend growth, but its share price has only grown 1.67% on average over the past 10 years. In an industry where many of its products are staples, this slow growth is surprising. While the dividends are reliable, the stock isn't really helping your investment grow. Hormel Foods is another company that has a decent dividend yield of 3.87% and has increased its dividends for 58 years, but similar to others in this category, its share price has only increased by 1.38% over the past decade. Hormel's focus on stable but slow-growing markets could be why its stock price hasn't performed better. Again, you get the dividends, but the lack of growth could leave your portfolio stagnating. And then there's Archer Daniels Midland, a leader in food processing and commodities, offering a 3.9% dividend yield and a 49-year streak of dividend growth. But despite its strong position in the market, its share price has only grown by 0.5% over the last decade. It's another example of a reliable dividend payer that struggles to provide any significant growth. Finally, we have National Fuel Gas, West America Bank Corporation, and PPG Industries. These companies operate in different industries, energy, banking, and industrial coatings, but they share the same issue: poor share price growth. National Fuel Gas has a 2.94% yield, but has only grown 0.63% over 10 years. West America offers a 3.43% yield, but has only grown 1.88%. PPG, meanwhile, despite its long history, has only managed a 0.17% increase in share price. These numbers show that even companies with solid dividends can struggle to grow their stock prices. While they might be reliable income sources, they won't help much if you're looking to build long-term wealth. So what's the takeaway here? The underperformers might offer steady dividends, but their lack of growth makes them less attractive for long-term investors. If you're looking for consistent income and don't care about capital appreciation, well then these stocks might just have a place in your portfolio. But if you want your investments to grow and build wealth over time, you might be better off looking at other categories with stronger growth potential. So don't worry if these dividend aristocrats have disappointed you. The next categories have companies that offer a better balance of dividend income and growth, giving you the best of both worlds. And that brings us to our next category, which is low growth with moderate yield. After looking at the underperformers, which struggled with both dividend yields and share growth, we now move to a slightly better group, the low growth with moderate yield stocks. These companies offer dividend yields between 2 and 4%, which is decent for generating steady income. However, their 10-year share price appreciation is between 2% and 5%, meaning their stock prices aren't growing very quickly. But they are better than the last category. First up in this category is Bank OZK. With a dividend yield of 3.31%, Bank OZK has been increasing its dividends for 27 years. However, its average share appreciation sits at just 4.18%. Now, this isn't terrible, but it's not enough to make your investment grow significantly over time. The banking sector can be stable, but it also faces a lot of regulations and is influenced by interest rates, which can slow down growth. Banks are great if you want consistent dividend income, but if you're looking for exciting growth, they might feel a bit too predictable. Next, we have Colgate-Palmolive, a household name that's been growing its dividends for 61 years. While the company offers a 2.31% dividend yield, its share price has only appreciated by 2.28% on average each year over the past decade. So why isn't Colgate growing faster? Why is growth so slow for such a well-known company, right? Well, the answer lies in the mature nature of the consumer goods industry. People will always buy toothpaste and soap, but there's not much room for explosive growth in this sector. Colgate is reliable for steady income, but it won't do much to grow your portfolio quickly. Next is H.B. Fuller, a company that makes industrial adhesives and sealants. Fuller offers a 1.41% dividend yield and has been growing its dividends for 55 years. Its share price has grown 3.96% over the past decade, which is slightly better. Fuller operates in a niche market, which gives it some stability but also limits its growth potential. While the company is solid, it's not going to deliver the kind of big returns that faster-growing sectors like tech might offer. New Jersey Resources is another one in this category. It's an energy company that focuses on natural gas and clean energy solutions. It has a 3.75% dividend yield and has increased its dividends for 35 consecutive years. While that's a solid track record, NJR's share price has only grown an average of 3.8% over the past 10 years. The energy sector can be tricky because it's heavily influenced by market fluctuations and regulatory changes. New Jersey offers steady income, but its growth is tied to energy prices and environmental policies, which can slow things down. It's a safe, income-generating stock, but the growth side is more fluctuated. Next in this category is the York Water Company. It might not be a name you hear every day, but it's been paying dividends for a long time. It offers a 2.83% dividend yield and has been increasing its dividends for 31 years. Water utilities are known for being stable investments because people will always need water. However, this stability also means limited growth potential. York Water is a great choice if you want to invest in something safe and consistent, but it won't deliver huge returns. After all, over the past 10 years, it only has an average share price appreciation of 2.72%. Next, we have C.H. Robinson Worldwide, a logistics company that helps businesses manage transportation and supply chains. The company has a 2.49% dividend yield and has been growing its dividends for 27 consecutive years. The logistics industry can be a slow grower because it's tied to global trade and economic cycles. Robinson provides steady income, but its growth is tied to how well the economy is doing overall. It's a good pick if you want reliable dividends and don't mind slower growth. Next, we have Tennant Company, which makes cleaning equipment, things like floor scrubbers and sweepers. It offers a low 1.38% dividend yield, but has a solid 52 years of dividend growth. However, its stock has grown by an average of 2.44% over the past decade. Cleaning equipment might seem like a boring industry, and the slow growth reflects that. Tenant is a dependable choice if you're looking for low-risk income, but it's not the kind of stock you'll buy for rapid appreciation. Tompkins Financial Corporation is another regional bank that offers a 3.54% dividend yield and has increased dividends for 27 consecutive years. Its share price on average has grown 2.87% over the last decade. Regional banks like Tompkins can be stable, especially since they focus on serving local markets. But their growth tends to be slow and predictable, meaning if you want more than just steady dividends, you might be better off looking at other stocks with stronger growth potential. The last stock in the low growth and moderate yield category is Stepan Company. This is a niche manufacturer in the specialty chemicals industry, producing things like surfactants for cleaning products, agricultural additives, and polymer polyols for insulation materials. This diversified product portfolio provides stable revenues but limited growth, and indeed the company's stock price has seen only slow appreciation, recently hovering near 52-week lows with relatively low volatility at the time those lows were recorded. However, Stepan compensates for its modest growth with very steady dividends. 2025 marked its 57th consecutive year of annual dividend increases. This long-running commitment to shareholder payouts gives Stepan a modern dividend yield of around 2.5%, helping you earn a reasonable return even when the stock's price gains are subdued. The low growth with moderate yield group offers consistent dividends and slow, steady growth. These stocks are great for investors who want to generate income while minimizing risk. However, if you're looking to build wealth quickly, these companies might feel a bit too slow for your liking. But don't worry, because later on as we move up the tier list, there are better options to come. I'll show you stocks opposite to this category which have high dividend growth and high stock appreciation. And at the end, I'll show you high growth stocks that on average have increased their share prices by over 20% each year for the last decade. Now that we've gone through underperformers and the low growth with moderate yield groups, it's time to look at a more promising set of stocks, the moderate performers. These are companies that offer a dividend yield between 2 and 3%, while their 10-year average annualized share appreciation ranges from 5 to 10%. This makes them appealing to investors who want both steady income and respectable growth. Think of moderate performers as the middle ground. They won't skyrocket like high-growth tech stocks, but they won't move at a snail's pace either, like some of the companies we've already covered. These stocks are great for building a portfolio that grows over time while still giving you consistent dividends to reinvest or spend. So let's take a closer look at the companies in this category and see why they might be the perfect fit for your investment strategy. First up in the moderate performers is the community bank system with the ticker CBU. It offers a 2.1% dividend yield and has been increasing its dividends for 32 consecutive years. Over the past 10 years, its share price on average has grown by 6.39%. Community banks like CBU tend to have a strong connection to their local markets, which makes them stay stable even when larger banks face challenges. CBU has managed to grow steadily while keeping shareholders happy with consistent dividends. It's not going to deliver massive returns, but it provides a nice balance of growth and income, ideal for investors who like to play it safe but still want their money to grow. Next is IBM, a true giant in the tech industry that's been around for over a century. IBM offers a 2.61% dividend yield and has been growing its dividends for 35 consecutive years. Over the past decade, IBM's share price has grown by 5.38%. IBM is a bit unique because it operates in technology, an industry known for rapid growth, yet it moves at a slower pace compared to other tech giants like Microsoft or Apple. The company has been shifting its focus from hardware to cloud computing and AI, which has helped boost its growth in recent years. While it may not deliver the explosive gains of newer tech companies, IBM does provide a steady income stream and moderate growth, making it a good choice for tech-savvy investors looking for a less volatile option. Water is one of the most essential resources on the planet, and California Water Service Group with the ticker CWT knows how to capitalize on that. CWT offers a 2.65% dividend yield and has been increasing its dividends for an impressive 57 consecutive years. Over the past 10 years on average, its share price has grown by a respectable 5.88%. Utilities like CWT are known for their stability. People will always need water, and this consistent demand helps keep the company's revenue stable. While the growth isn't explosive, the combination of steady dividends and modest share appreciation makes CWT a reliable option. Next, we have First Source Corporation and General Dynamics in this category. These two companies operate in very different industries, banking and defense, but they both fall into the moderate performers category. First Source Corporation offers a 2.3% dividend yield and has been growing its dividends for 37 consecutive years. Its share price has grown 8.23% over the past decade. As a regional bank, First Source Corporation provides stable income and benefits from local economic growth, making it a solid investment for those who prefer community-focused banks. On the other hand, General Dynamics offers a 2.21% dividend yield and has been increasing dividends for 33 years. Its share price has grown by an average of 6.34% over the past decade. General Dynamics is a major player in the defense and aerospace industry, benefiting from consistent government contracts and military spending. This stability makes it a good pick for investors looking for moderate growth and steady income from a company that plays a key role in national defense. Old Republic International Corporation is another solid player in the moderate performers category. This insurance company offers a 2.9% dividend yield and has been increasing dividends for 43 years. Over the past 10 years, its share price on average has grown by 9.65%, making it one of the higher performers in this group. Insurance companies like Old Republic tend to have predictable revenue streams, which makes them a great option for income-seeking investors. The fact that ORI has managed to deliver strong share price growth alongside reliable dividends makes it an attractive pick for those looking for both stability and growth. Another water utility in this category is American States Water Company, with the ticker AWR. It offers a 2.5% dividend yield and has been increasing its dividends for an incredible 69 consecutive years, one of the longest streaks among Dividend Aristocrats. Its share price has grown 6.25% over the past 10 years. Like CWT, AWR benefits from the consistent demand for water services. The company has a monopoly in certain regions, which helps it maintain stable profits. The combination of decades-long dividend growth and steady share price appreciation makes AWR a rock-solid investment for this category. Next up, we have MGE Energy and McCormick & Company. Both are well-established companies with consistent performance, but they operate in very different industries, utilities, and food products. MGE offers a 2% dividend yield and has been increasing its dividends for 48 consecutive years. Its share price has grown by an average of 6.69% over the past decade. As a utility company, MGE benefits from the essential nature of its services, providing steady income and modest growth. On the other hand, McCormick & Company, known for its spices and seasonings, offers a 2.33% dividend yield and has been growing dividends for 99 consecutive years, almost a full century. Its share price on average has grown 7.72% over the past 10 years. McCormick benefits from the global demand for its products and the company's strong brand recognition. While it operates in a mature industry, McCormick's steady growth and reliable dividends make it a great pick for conservative investors. No list of Dividend Aristocrats would be complete without mentioning Procter & Gamble with the ticker symbol PG. PG offers a 2.43% dividend yield and has been increasing its dividends for 68 consecutive years. Over the past decade, its share price on average has grown 6.8%. PG is a consumer goods giant, with products ranging from laundry detergents to baby care items. Its wide range of well-known brands like Tide, Pampers, and Gillette makes PG a household name and a stable investment. While its growth isn't explosive, the combination of consistent income and steady share price appreciation makes PG a favorite for investors looking for reliability. Next, we have Lancaster Colony Corporation and Cullen/Frost Bankers. LANC offers a 2.25% dividend yield and has been increasing its dividends for 61 consecutive years. Its share price has grown by an average of 6.33% over the past 10 years. Lancaster Colony is known for producing specialty foods, including the famous Marzetti salad dressings. The company operates in a niche market, which helps it maintain consistent revenue and dividend growth. Frost Bankers, on the other hand, offers a 2.73% dividend yield and has been growing its dividends for 30 years. On average, its share price has grown 7.52% over the past decade. As a regional bank in Texas, Frost Bankers benefits from the state's strong economy and growing population. This has helped the bank maintain steady growth while offering a solid dividend. Lastly, we have Atmos Energy, a fully regulated natural gas utility serving millions of customers across several states, which gives it a stable and reliable business foundation. The company has a decades-long track record of steady dividend growth. It has increased its dividend every year since the early 1980s, earning Atmos the status of Dividend Aristocrat. It has a current dividend yield of 2.44%. As for the share price growth, it increases on average 9.42% every year, making it one of the best in this category. So the Moderate Performers Group is perfect for those who want to build a portfolio that grows steadily over time without taking on too much risk. These stocks won't deliver the rapid gains of high-growth stocks, but they provide reliable dividends and consistent share price appreciation. If you're looking for a mix of income and growth without the roller coaster ride, these stocks are a great choice. However, if you're ready to explore even more growth potential, the next category is where things really start to get exciting. Stable growth with modest yield. Companies in this category offer dividend yields between 1 and 2%, which might seem low at first, but don't let that fool you. Their 10-year share appreciation sits on the higher side of the 5 to 10% range, which means they're quietly growing in the background while still rewarding shareholders with consistent dividends. Think of these stocks as steady achievers. They might not grab headlines with flashy dividend payouts, but they steadily build wealth over time. If you're an investor looking for long-term growth with a side of reliable dividends, this category might be perfect for you. These companies are great for people who don't need immediate income but want their investments to grow steadily while providing some passive income. So let's look into the companies that make up this category and see what makes them stand out. First up is Aptar Group. This company offers a 1.15% dividend yield and has been growing its dividends for 31 consecutive years. Over the past decade, ATR's share price on average has increased by 9.49%, which is impressive for a company with such a modest dividend. Aptar Group specializes in dispensing systems, things like the pumps on your lotion bottles, spray tops on perfumes, and packaging for pharmaceuticals. While this might not sound glamorous, Aptar Group plays a vital role in industries like healthcare, beauty, and food packaging. Because its products are in constant demand, the company has enjoyed stable growth and consistent revenue. While the dividend isn't huge, the company's steady growth makes it a solid pick for investors looking to grow their wealth over time. Next up is Ecolab, a leader in water hygiene and energy technologies. Ecolab offers a 1.04% dividend yield and has been increasing dividends for 32 consecutive years. Its share price has grown 8.96% over the past 10 years. Ecolab helps businesses keep their operations clean and efficient, from restaurants and hospitals to industrial plants. In a world where sanitation and sustainability are becoming more and more important, Ecolab's services are always in demand. The company's focus on environmentally friendly solutions gives it a competitive edge in a growing market. While its dividend yield is on the smaller side, the company's share price on average has grown by 8.96% every year over the past decade. Investors who are looking for consistent, reliable growth while still getting some dividends will find Ecolab an attractive pick. Next up, let's take a look at Raytheon Technologies Corporation and Albemarle Corporation. These two companies operate in very different industries, defense and aerospace for Raytheon and specialty chemicals for Albemarle, but they both fit into the stable growth with modest yield category. Raytheon offers a 1.95% dividend yield and has been growing its dividends for 35 consecutive years. Its share price has grown by an average of 5.63% over the past 10 years. Raytheon is a major player in the defense industry, providing aerospace solutions and military technology to governments around the world. While the industry can be volatile due to political factors, Raytheon's diverse portfolio helps keep it steady. On the other hand, Albemarle Corporation offers a 1.92% dividend yield and has been growing its dividends for 30 years. It has an average share price appreciation of 5.48%. Albemarle is one of the world's largest producers of lithium, which is essential for electric vehicle batteries and renewable energy storage. As the world continues to move toward clean energy, Albemarle stands to benefit from long-term growth. Both companies offer modest dividends, but their potential for future growth makes them attractive for those who are thinking about the big picture. Donaldson Company is another strong performer in this category. Donaldson offers a 1.52% dividend yield and has been increasing its dividends for 37 consecutive years. Over the past 10 years, its share price has grown by an average of 6.62%. Donaldson specializes in filtration systems for everything from industrial machinery to automobiles. Clean air and efficient filtration are essential in today's industries, and Donaldson's products help companies maintain their equipment and reduce environmental impact. The company's focus on innovation and sustainability has helped it grow steadily over time. Becton Dickinson and Company, commonly known as BD, is a medical technology company that offers a 1.68% dividend yield and has been increasing its dividends for 52 consecutive years. BD is known for its medical devices such as syringes, infusion systems, and diagnostic equipment. The healthcare sector is always in demand, and BD's products are used in hospitals, clinics, and research labs around the world. The company's commitment to innovation and improving patient care has helped it maintain steady growth. Over the past decade, BD's share price has grown by an average of 6.04%. Next, we have Emerson Electric, a global technology and engineering company that offers a 1.62% dividend yield and has been increasing its dividends for 28 consecutive years. The business provides automation solutions and commercial technologies for industries like energy, manufacturing, and healthcare. The company's focus on innovation and efficiency has helped it grow steadily, even during challenging economic times. The stock's average annual share price sits around 8.14%. Emerson's diversified portfolio makes it a resilient choice for investors who want a mix of stability and growth. Last but not least is Expeditors International of Washington. Expeditors offers a 1.29% dividend yield and has been increasing its dividends for 31 consecutive years. EXPD is a global logistics company that helps businesses manage their supply chains and freight transportation. As the world becomes more connected and global trade continues to grow, companies like EXPD are in high demand. And that's why, over the past decade, it's had an average share price growth of 9.87%, which is one of the highest in this category. The company's ability to adapt to changing markets and economic challenges has helped it achieve strong growth while still paying reliable dividends. So the stable growth with modest yield group is perfect for investors who want to grow their wealth steadily while still receiving reliable dividend income. These companies might not offer the highest dividends, but their consistent performance and steady share price appreciation make them solid long-term investments. Up next, I'll show you the category Stable Income, where we'll look at stocks that focus more on income generation without compromising on stability. Later on, as we move up the tier list, I'll show you stocks that offer both high dividend growth and high stock appreciation. And at the end, I'll show you high growth stocks that, on average, have increased their share prices by over 20% each year for the past decade. But first, let's look into the stable income category. These companies offer dividend yields of 3% or more, which means they provide a consistent cash flow. However, their 10-year share price appreciation is a bit slower, generally between 2 and 5%, but not negative. While they won't make your portfolio skyrocket overnight, these companies provide an excellent foundation for long-term income stability. So let's take a closer look at these income-generating champions and see what makes them stand out. First up is Chevron Corporation, one of the biggest names in the energy sector. Chevron offers a generous 4.58% dividend yield and has been growing its dividends for 37 consecutive years. Chevron's business focuses on oil and natural gas, which can be a double-edged sword. When oil prices are high, the company thrives, but when prices fall, growth can slow down. However, Chevron has managed to maintain steady dividends through all kinds of market conditions thanks to its global operations and diversified energy portfolio. As for its stock growth, over the past decade, it has managed an average share price growth of 3.14%. Next, we have two relatively smaller companies that offer stable dividends: Artesian Resources Corporation and Arrow Financial Corporation. Artesian offers a 3.89% dividend yield and has been increasing its dividends for 30 consecutive years. On average, its share price has grown 3.2% each year over the past decade. Artesian is a water utility company, which means it provides an essential service that people can't live without. This makes it a defensive stock, one that performs well even during tough economic times. Similarly, Arrow offers a 4.21% dividend yield and has also grown its dividends for 30 years. It has a share price growth rate of 2.51%. Arrow Financial is a regional bank that focuses on providing banking services in its local communities. While banks can be sensitive to interest rates and economic downturns, regional banks like Arrow tend to be more stable because of their close ties to their local communities. Both of these companies offer consistent income with modest growth, making them great options for investors who prioritize reliable dividends. When it comes to household names in investing, Johnson & Johnson is always at the top of the list, and it also gets its spot in the stable category. J&J is a healthcare giant, producing everything from medical devices and pharmaceuticals to consumer health products like Band-Aids and baby shampoo. The stock offers a 3.26% dividend yield and has been increasing its dividends for an incredible 62 consecutive years. Its share price has grown 4.03% on average each year. With its combination of reliable dividends and steady growth, J&J is perfect for investors who want stability in their portfolios while still seeing modest capital appreciation. This category holds two more water utility companies, Essential Utilities and SJW Group. Essential Utilities offers a 3.67% dividend yield, has been growing its dividends for 31 consecutive years, and has an average share price appreciation of 2.52% over the last 10 years. Similarly, SJW offers a 3.34% dividend yield and has increased its dividends for 57 consecutive years. It offers an average share price appreciation of 3.77%. Water utilities tend to be low-risk investments because demand for water is constant. While the share price growth isn't impressive, these companies offer consistent dividends that make them great for investors looking for steady income without a lot of volatility. Next, we have two of the biggest names in the beverage industry, PepsiCo and the Coca-Cola Company. These companies have been battling for the top spot in the soft drink market for decades, and they're both fantastic choices for income-focused investors. PepsiCo offers a 3.6% dividend yield and has been increasing its dividends for 52 consecutive years. It has an average share price appreciation of 4.59%. While Pepsi is known for its soft drinks, the company also has a strong presence in the snack food market with brands like Lay's and Doritos, which helps diversify its revenue. Coca-Cola, meanwhile, offers a 3.06% dividend yield and has been growing its dividends for 62 years. Its share price has appreciated 4.31% on average over the past 10 years. Both companies offer solid dividend income and slow but consistent growth. They're great picks for investors who want to invest in well-established brands that continue to perform year after year. Next, we have T. Rowe Price Group and Consolidated Edison. These companies are in different industries, investment management and utilities, but they both offer stable income and steady growth. Rowe offers a 4.24% dividend yield and has been increasing its dividends for 38 consecutive years. T. Rowe Price is a financial services company that manages investments for individuals and institutions. The company benefits from a steady income and a reputation for strong financial management. As for its stock growth, it has maintained an average 3.71% stock growth over the past decade. Consolidated Edison offers a 3.63% dividend yield and has been growing its dividends for 50 years. It has a share price of 3.11%. As a utility company, Edison provides essential energy services to millions of people in the New York City area. The Clorox Company and Universal Corporation are two more companies that offer a stable income. Clorox offers a 3.08% dividend yield and has been increasing its dividends for 47 consecutive years. Clorox is known for its cleaning products, which definitely saw a spike in demand during the COVID-19 pandemic. While the company's growth has slowed since then, it remains a reliable dividend payer. Over the past decade, it has averaged a share price appreciation of 3.95% each year. Universal, on the other hand, offers a 6.1% dividend yield, the highest in this group, and has been growing its dividends for 53 years. However, its share price has only averaged 2.25% over the last decade. Universal Corporation is involved in the tobacco industry, which faces challenges due to regulations and declining smoking rates. Last but not least is Target Corporation, one of the most popular retailers in the United States. Target offers a 3.25% dividend yield and has been increasing its dividends for 56 consecutive years. Target has done an excellent job of adapting to changing shopping habits, investing in e-commerce and store renovations to stay competitive. This can also be seen from its average share price growth of 6.16%, which is also one of the highest in this category. The company's ability to balance growth with reliable dividends makes it a standout in the stable income category. So, the stable income group is perfect for investors who want to generate consistent cash flow from their investments without worrying about the ups and downs of the stock market. These companies may not offer explosive growth, but their reliable dividends and steady share appreciation make them ideal for long-term income-focused portfolios. Next, we'll look into the high-yield, low-growth category, where companies offer even higher yield potential but slower stock growth. In this category, companies offer dividend yields of 4% or more, which means they provide large, regular payouts to shareholders. These stocks are like cash cows. They give you big dividends regularly, but don't expect their stock prices to grow much. In fact, some of these companies have seen their stock prices decline over time. This makes them great for people who want immediate income, like retirees or those who rely on dividends to pay bills. They might not be the best choice for investors looking to grow their wealth through capital appreciation. Let's take a closer look at these high dividend payers and explore why their share prices might be struggling despite their generous payouts. Let's start with Sonoco Products Company. Sonoco is in the packaging industry, producing everything from consumer packaging to industrial containers. While packaging isn't always in demand, it's a competitive market with thin profit margins. This means the company doesn't have much room for explosive growth, but it can still generate steady cash flow to support its high dividends. The stock offers a 4.37% dividend yield, which is quite generous, and has been growing its dividends for 42 consecutive years. But when we look at its share price growth, it only goes up by 0.51% on average each year. Next, we have National Retail Properties and Black Hills Corporation. Both companies offer high yields. National Retail is a real estate investment trust, or REIT in short, that focuses on freestanding retail properties. While REITs are known for their high dividends, they can struggle with growth if the retail sector faces challenges like the rise of e-commerce. The stock offers a 5.89% dividend yield and has been increasing its dividends for 34 consecutive years. However, its share price has actually declined by 0.72% over the past decade. Now, Black Hills is a utility company that provides natural gas and electricity. Utilities are known for their stability, but they often face regulatory challenges that can limit growth. Still, it offers a 4.6% dividend yield and has been growing its dividends for 35 years. Next, both UGI Corporation and Northwest Natural Holding Company fall squarely into the high-yield, low-growth category, with each offering strong dividend payouts but underperforming in terms of capital appreciation. UGI provides natural gas and energy services, but the company has faced challenges with market volatility and rising costs. It offers a 4.88% dividend yield and has been increasing its dividends for 37 consecutive years. However, its share price has declined by 2.25% over the past decade. Like UGI, Northwest operates in the natural gas sector, which can be heavily impacted by fluctuating energy prices and regulatory changes. It offers a 4.91% dividend yield and has an impressive 68-year streak of dividend growth. Despite this, Northwest's share price has seen an average yearly decline of 2.42% over the past 10 years. Altria Group is one of the most well-known names in the tobacco industry of this category. It's the company behind Marlboro cigarettes, but the decline in smoking rates and increasing regulations on tobacco products have made growth difficult. Despite these challenges, Altria continues to generate strong cash flow, which it returns to shareholders in the form of high dividends. It offers a massive 7.81% dividend yield and has been growing its dividends for 55 consecutive years. For those looking for big dividend payouts, Altria is hard to beat, but the long-term future of the tobacco industry is uncertain, which makes this stock riskier than some of the others in this category. Next, we have Polaris, which operates in a cyclical industry, meaning its performance is closely tied to the economy. It's known for making off-road vehicles, snowmobiles, and motorcycles. When times are good, people are more likely to buy recreational vehicles, but during economic downturns, sales can plummet. This makes the company's revenue volatile, which explains the decline in its stock price. The stock offers a 5.62% dividend yield and has been growing its dividends for 28 consecutive years. While Polaris offers a high dividend yield, its poor share price performance that declines on average 10.59% makes it a risky investment for anyone looking for long-term growth. Last but not least is Enterprise Products Partners LP, with the ticker EPD, a major player in the energy infrastructure sector. It operates pipelines and storage facilities for natural gas and petroleum products. While the company generates steady cash flow from its infrastructure assets, the energy sector is highly sensitive to market fluctuations and regulatory risks. This can make it difficult for companies like EPD to achieve significant share price growth. The stock offers a 6.55% dividend yield and has been growing its dividends for 26 consecutive years. So the high-yield, low-growth category is perfect for those who want immediate income and aren't too concerned about capital appreciation. These companies offer generous dividends and have proven they can maintain payouts even during tough times. However, their slow or negative share price growth makes them less appealing for those looking to build wealth over time. However, if you're looking for a balance between dividend income and stock appreciation, the next category, dividend growth with high appreciation, is where you'll want to focus. And after that, I'll show you the high-growth stocks that on average have increased their share prices by over 20% each year for the last decade. But first, let's look into stocks that have dividend growth with high appreciation. Some companies give you two benefits at once. They pay you money for owning their stock, and their stock price also goes up over time. This balance of dividend income and stock price growth is why we call them dividend growth with high appreciation stocks. Let's take a look at some of the top companies in this category and why they stand out. Republic Bancorp is a regional bank that has built a strong reputation over the years. It's not as big as some of the major banks, but it has a solid track record. The company offers a 2.76% dividend yield, and its stock has grown by 10.72% over the last decade. Republic Bancorp has been increasing its dividend for 26 consecutive years, which is a great sign of stability. Despite being a smaller bank, Republic Bancorp has done a good job in managing its growth and staying steady during tough times. If you're looking for a reliable income source with steady growth, this bank is a great option to consider. The next stock in this category is Fastenal, a leading distributor of industrial supplies, tools, fasteners, and safety equipment, and it plays a key role in many growing industries. Fastenal offers a 2.35% forward dividend yield and has seen its share price appreciate by 12.33% on average. The company has been consistently increasing its dividends for 32 years. It has established a strong customer base in the industrial sector, and as industries continue to expand, so does the demand for Fastenal's products. While its dividend yield isn't the highest, its solid stock price growth and dependable income make it a great pick for those who want a mix of both. Next, we have ADP, a massive player in payroll and human resources services, helping businesses around the world manage their payroll, benefits, and compliance. The company offers a 2.03% forward dividend yield and has seen a solid 13.54% share price appreciation on average. The stock has been growing its dividend for 49 consecutive years, which is a huge mark of consistency and stability. With new technology making their services even more efficient, ADP stands to keep growing, making it an excellent choice for long-term investors looking for both reliable dividends and stock price appreciation. NextEra Energy is another stock that rocks this category. It's a leader in renewable energy, focusing heavily on wind and solar power. It's an exciting option for investors looking for environmentally conscious companies that also provide strong financial returns. The stock offers a 2.88% forward dividend yield and has enjoyed an annualized 10.01% increase in share price over the past decade. The company has been increasing its dividends for 35 years, making it a reliable choice for dividend-seeking investors. As global demand for clean energy rises, and with governments pushing for cleaner energy, NextEra is expected to keep growing while continuing to pay investors well. Next in this category is Illinois Tool Works, a diversified industrial company that makes products for various industries, from automotive to food processing. With a 2.32% forward dividend yield and 10.46% stock price annualized growth, ITW has shown strong, consistent performance. It's been increasing its dividend for 49 consecutive years. ITW's wide range of industries and consistent innovation have allowed it to grow even when certain sectors slow down. Our next favorite stock in this category is Cincinnati Financial. It's one of the longest-running insurance companies in the market, offering solid returns through smart risk management. It's been able to navigate the ups and downs of the market and remain profitable in the insurance industry, which has made it a favorite for income-focused investors. With its solid performance, even during economic downturns, Cincinnati Financial is an ideal stock for investors looking for reliable income and steady stock price appreciation over the long term. It offers a 2.36% forward dividend yield and has an average 10.15% stock price growth each year. The company has been growing its dividend for 64 consecutive years, making it a standout in terms of consistency. And lastly, rounding out the list of dividend growth with high appreciation category is Aflac, a household name thanks to its mascot, the duck, but it's also known for its strong financial performance in the insurance space. Aflac's business model has proven stable even during economic slowdowns, and its supplemental insurance products continue to see demand. Aflac offers a 2.16% forward dividend yield and has seen 13.77% stock price growth on average over the last 10 years. It has increased its dividend for 42 consecutive years, a strong indicator of its reliability and commitment to shareholders. If you're seeking both a solid income stream and growth potential, Aflac delivers both with its reliable dividend and steadily increasing stock price. Okay, so while the dividend growth with high appreciation category offers a balance of steady income and rising stock prices, some investors are willing to take on more risk for even greater rewards. That's where the high growth category comes in. These companies may not have the highest dividend payouts, but they make up for it with rapid share appreciation. They're often leaders in innovative industries, constantly expanding and reinvesting profits to fuel future growth. If you're looking for stocks with the potential to skyrocket, this next group is for you, the High Growth Group. These are the companies that may not offer big dividend payouts. In fact, they may have dividend yields below 2%, but they more than make up for it with explosive share price appreciation. All of the companies in this category have seen their share prices grow by over 10% to even 20% or more each year in the past decade. High-growth stocks are perfect for investors looking to supercharge their portfolios. While the dividends are modest and sometimes barely noticeable, these companies are innovating, expanding, and dominating their markets. If you're in the market for capital gains and are less focused on immediate income, this category is where you'll find your next big opportunity. Let's take a closer look at these high-growth stars and see how they've been outperforming the market. Kicking off this category are Franklin Electric and Brady Corporation. These companies may not be household names, but their performance speaks volumes. Franklin offers a 1.06% dividend yield and has been growing its dividends for 30 years. Franklin Electric specializes in pumping systems and fluid management technologies. With the growing demand for clean water and efficient energy use, Franklin Electric is positioned to keep expanding. Over the past decade, its share price has increased by an average of 10.87% each year. Brady, on the other hand, offers a 1.29% dividend yield and has been growing its dividends for 38 years. Brady Corporation focuses on workplace safety products and identification solutions. Think of labels, signage, and safety systems used in industries worldwide. Its average share price growth has also been consistently over 10% over the last 10 years. Both Franklin and Brady offer steady, modest dividends, but their real value comes from long-term growth potential in industries that are essential to the global economy. Next is Walmart. It offers a 0.85% dividend yield and has been increasing its dividends for 51 consecutive years. Its share price has grown by 13.07% over the past decade. Walmart continues to dominate the retail sector, adapting to changing consumer behaviors with its focus on e-commerce and logistics. The company's ability to balance low prices with operational efficiency has made it a consistent winner in the stock market. The next two stocks in this category belong to the home improvement sector: Lowe's Companies and Sherwin-Williams Company. Lowe's has benefited from the booming housing market and the rise in DIY home projects. The company's focus on e-commerce and store optimization has helped drive both revenue and profit growth. Lowe's offers a 1.77% dividend yield and has been growing its dividends for 61 years. As for its average share price growth, it has recorded a solid 14.08% annualized return over the past 10 years. Sherwin-Williams, meanwhile, offers a 0.8% dividend yield and has been increasing its dividends for 46 years. Its share price has appreciated an average of 14.66% each year over the past 10 years. Sherwin-Williams is a leader in paint and coatings, serving both residential and commercial markets. Both Lowe's and Sherwin-Williams combine solid business models with strong growth potential, making them excellent picks for long-term investors. Next, we have Casey's General Stores and Roper Technologies, two very different companies that share one thing in common: impressive growth. Casey's operates a chain of convenience stores in the Midwest, focusing on fuel sales, grocery items, and even freshly made pizza. The company's ability to cater to small-town markets and adapt to consumer needs has driven its growth. Casey's offers a 0.47% dividend yield and has been growing its dividends for 34 years. Its share price has averaged around 16.28% over the past decade. Roper, meanwhile, offers a 0.57% dividend yield and has been increasing its dividends for 27 years, and its share price has averaged around 13.68% over the past 10 years. Roper Technologies is a diversified company specializing in software and industrial technology. Its focus on high-margin businesses and recurring revenue streams has made it a consistent performer in the stock market. Next up, let's group together Grainger, Caterpillar, and Carlisle companies, three industrial giants that have shown impressive growth over the years. Grainger offers a 0.77% dividend yield with 15.82% average share price growth over the last decade. Caterpillar offers a 1.52% yield with 16.04% growth. And Carlisle offers a 1.03% yield with 15.57% growth. These companies operate in the industrial and manufacturing sectors, providing essential equipment and solutions for industries around the world. Next is Bank First Corporation, a regional bank that has built a solid reputation by focusing on strong relationships with local businesses and individuals. Unlike larger banks, Bank First stays connected to its community, offering tailored financial services that help its businesses grow steadily over time. This focus on local engagement and prudent lending strategies has allowed Bank First to maintain consistent growth both in stock price and services offered. With a 1.55% dividend yield and 31 consecutive years of dividend increases, Bank First has shown a solid commitment to rewarding its shareholders. Better than that, it has maintained an average share price appreciation of 14.91%. Then there is RPM International. It's a leader in the manufacturing of paints, coatings, and building materials used in residential and commercial markets. Over the years, RPM has established itself as a reliable company in a competitive industry, known for its ability to expand product lines and improve technology. It has a 1.61% dividend yield and 50 consecutive years of dividend growth. The company has also seen a 10.2% average yearly increase in stock price over the past decade. RPM reinvests a significant portion of its earnings back into its business, which has allowed it to maintain steady growth and a consistent dividend payout. The next stock in this category is Dover. It makes many kinds of machines and industrial equipment used in different industries, from energy to food packaging. It grows by creating new products and acquiring smaller companies, which helps it expand into new markets. Instead of paying big dividends, Dover reinvests in its business to improve its technology and production. This strategy has helped its stock price grow over time, rewarding investors with long-term gains. As a company with 68 consecutive years of dividend growth, it also provides a small but consistent payout, making it a well-balanced high-growth stock. The company has a 1.01% dividend yield, but most importantly, it has maintained an average stock price growth of 13.08% over the past decade. While its dividend yield may be lower than some other companies, its strong performance and focus on reinvestment into new technologies and markets make it an attractive long-term investment for those seeking both stability and growth. Our next stock is FactSet, a financial data and analytics company that helps businesses make better investment choices. It provides software and research tools used by banks, investors, and financial analysts. FactSet continues to grow by investing in better technology and expanding its services rather than paying large dividends to shareholders. This focus on innovation has helped its stock value grow steadily over time. With more companies relying on data to make decisions, FactSet's business is expected to stay strong and keep delivering long-term growth. The company has a low 0.88% dividend yield and has been growing its dividend for 25 consecutive years. Over the past decade, FactSet's stock price has grown by an average of 12.3% each year, reflecting its steady progress and the increasing demand for data-driven investment insights. Next in this category, we have Nucor, one of the largest steel producers in the United States, supplying materials for buildings, cars, and infrastructure. Instead of paying high dividends, Nucor reinvests in its business by building new factories and adopting modern steelmaking technologies. This investment helps the company lower costs, increase efficiency, and remain competitive in the industry. As the demand for steel continues to rise, Nucor is positioned to grow even more, making it a valuable long-term stock. Despite its focus on stock growth, which stands at an average 10.88%, Nucor still offers a good dividend yield of 1.71%, giving investors a mix of income and appreciation. West Pharmaceutical Services and S&P Global are two more examples of companies that have mastered both growth and dividends, but in very different ways. West Pharmaceutical provides packaging and delivery solutions for the healthcare industry, including injectable drug packaging. The company's success is tied to the pharmaceutical sector's growth and its focus on innovative healthcare solutions. West Pharmaceutical offers a tiny 0.25% dividend yield, but its share price growth has been massive, averaging 21.21% over the past decade. S&P Global, the parent company of Standard & Poor's, plays a crucial role in financial markets by providing credit ratings, market intelligence, and data analytics. As the global economy becomes more data-driven, S&P's importance continues to grow. It offers a 0.74% dividend yield and has been increasing dividends for 51 years. Its share price has averaged around 18.69% over the last 10 years. These two companies are perfect for investors who prioritize capital appreciation. While the dividends are minimal, the share price growth more than compensates for it. Best 3 ETF portfolio for long-term investing. Simple investing in 2025. Most investing videos either overwhelm you with complex strategies or pitch you dreams with no backup. This isn't one of those videos. If you've ever felt like investing was confusing, time-consuming, or just not made for regular people, you're in the right place. Today, I'm breaking down a portfolio so simple anyone can start with it, yet so effective it can grow into 7 figures over time. I'm talking about just 3 ETFs, all built on timeless investing principles but upgraded for today's economy to handle challenges like inflation, interest rates, and market fluctuations. And in the end, I'll show you and John how this simple 3 ETF portfolio can turn a $10 daily investment into a retirement fund worth over $1 million. But first, where did this idea even come from, and why does it still work so well even in 2025? To answer that, we've got to rewind a little. It all started with a shift in mindset. Back in the early 2000s, a group of everyday investors, people who were tired of trying to beat the market, began rallying around the simple, no-nonsense investing philosophy of Jack Bogle, the founder of Vanguard, and built what is now known as the Boglehead 3 Fund portfolio. It was kind of genius how basic it was. One fund for U.S. stocks, one for international stocks, and one for bonds. That's it. No stock picking, no guesswork, just broad diversification and long-term growth. And it worked for most people. And over a couple of decades, this minimalist strategy outperformed many actively managed portfolios with far less risk. And while Wall Street was busy making things more complex, Bogleheads kept it simple and won. This philosophy attracted everyone from college students to retirees because it didn't require predicting the next big thing. It just worked. Slow, steady, and powerful. But we're not in 2000 anymore. Interest rates have shifted, inflation is sticking around longer, passive income is a top priority, and global markets look very different today. At the same time, people are craving more flexibility, more growth, and more control over their cash flow. Bonds? They're no longer the reliable safety nets they used to be, especially when dividend ETFs are offering better yields and long-term upside. So does that mean that the Boglehead model is outdated? Well, the answer to this is yes and no. The core principle is the same. Diversify, stay consistent, keep costs low. But what if we could keep that foundation and just upgrade it a little? What if we swapped in a few smarter ETF choices designed for today's economy, higher returns, better income potential, and more flexibility? That is exactly what I've done here. I've taken the same structure but plugged in ETFs that are built for how money works in 2025. Think of it as the Boglehead 3 Fund Portfolio 2.0. Same foundation, upgraded engine. So before we break it down piece by piece, let's make sure we're on the same page. What exactly is an ETF? Well, an ETF, short for Exchange Traded Fund, might sound fancy, but it's actually super simple. It's basically a bundle of investments, like stocks or bonds, packaged into a single fund you can buy and sell on the stock market. Think of it like a playlist of top-performing songs, but instead of music, you're getting a curated mix of assets. Instead of picking individual stocks, you invest in one ETF that automatically spreads your money across dozens, hundreds, or even thousands of assets. That means instant diversification without the headache of tracking multiple companies. And because ETFs are traded just like regular stocks, you can buy or sell them throughout the day at market prices. The best part? Most ETFs have super low fees compared to mutual funds or actively managed accounts. That means more of your money stays invested and compounds over time. So now that we've got the basics down, let's talk about how to actually use them, starting with the 3 simple rules that make this modern 3-fund portfolio so powerful. First, pick one ETF per category. The original Boglehead model used 3 core categories: U.S. stocks, international stocks, and bonds. In this modern version, I've upgraded the international and bond categories with more growth and income potential, but the structure stays the same. You only need one solid ETF for each category to keep it simple, clean, and easy to manage. Second, set a clear goal. Don't just invest blindly. Know what you're working toward. Do you want to retire by 60, cover your rent with passive income, or want a lump sum retirement fund? Be specific. The clearer your goal, the easier it is to stay motivated and stick to the plan even when the market gets rocky. Third, and most important, stay consistent. This goal tops everything else. Listen, you might think $10 a day doesn't move the needle, but do it for 30 years, and in the end, I'll show you how this portfolio can turn $10 a day into a portfolio worth over $1 million. The key isn't timing the market, it's time in the market. Automate your contributions and don't overthink the short-term noise. Stick to these 3 rules, and you're already ahead of most investors out there. But even a great strategy like this can fall apart if you make the classic beginner mistakes, and trust me, most people do. So before we look at the actual ETFs, let's talk about what not to do. One big slip up? Chasing the hype. Just because a stock is trending doesn't mean it belongs in your long-term plan. Stick to your ETFs and ignore the noise. Another one? Checking your portfolio too often. Watching every dip and spike only creates stress and leads to bad decisions. This portfolio is built for decades, not days. Lastly, switching ETFs too quickly. You don't need the hot new fund every year. Pick strong ETFs, then stay put. Avoid these traps, and your chances of hitting that $1 million mark go way up. Now that we've cleared that up, let's break down the first and most important part of the entire strategy, your foundation ETF. This is your main growth engine. If the rest of your portfolio is the structure, this is the concrete it stands on. It gives your investment stability, strength, and long-term direction. And that's why we mimic the U.S. stock market. Historically, the U.S. has outperformed almost every other market globally. The S&P 500 alone, which tracks the 500 largest companies in the U.S., has delivered an average annual return of around 10.5% over the last 30 years. That's not just solid, that's elite. When you invest in an ETF that tracks the S&P 500, you're not betting on one company, you're owning tiny pieces of the biggest, most powerful businesses on the planet. Apple, Microsoft, Google, Amazon, and hundreds more. You're holding the same assets that drive the global economy. Now, what makes this so powerful for long-term investors is the combo of capital appreciation and dividend income. Capital appreciation is when the ETF's share price goes up over time. Dividend income is the cash paid out regularly, usually quarterly, just for holding the ETF. And when you reinvest those dividends, that's when things get wild because you're earning on your earnings, and that compounding effect becomes a money-making machine over the years. The ETF I recommend for this category, the foundation, is the SPDR Portfolio S&P 500 ETF, ticker symbol SPLG. This fund is designed to track the full performance of the S&P 500 with ultra-low fees, high liquidity, and proven returns. It's one of the most cost-effective ways to get massive diversification in one single purchase. As for its reliability, SPLG has paid dividends for 17 consecutive years, and for the last 4 years, it has increased those dividends. That means not only are you getting paid, you're getting paid more every year. In a world where uncertainty is the norm, that kind of track record matters. The average annual return of SPLG is about 10.71%, with a dividend yield of 1.28% and a dividend growth rate, CAGR, of 7.29%. Next, I'll show you how much this ETF alone can grow a $10 daily investment over time, just as a reference. So let's put this into real numbers. Say John invests $10 a day or $300 a month in this ETF and reinvests the dividends. Here's what happens. After 1 year, he would have invested $3,600, setting the stage for future growth. After 10 years, he's looking at $62,414. By year 20, it's $246,645. And at year 30, his total portfolio value will hit $777,669. He would have invested $108,000 total over 30 years, but thanks to market growth and reinvested dividends, his portfolio would gain $669,669 in value. Out of that, around $35,344 comes directly from dividends being reinvested, and $634,325 from capital appreciation. Here's something most people overlook: the peace of mind this brings. You're not glued to CNBC. You're not stressing over earnings reports or trying to guess what the market will do next. You're simply investing in the backbone of the U.S. economy and letting it grow. That's exactly why this is your foundation, because when it comes to your core portfolio, you don't want chaos. You want something with a rock-solid track record, built on companies that have shaped and will continue to shape the world. SPLG gives you that. It's steady, it's proven, and it just works. Now, in the end, I'll show you and John how this, combined with 2 other ETFs, can turn a $10 daily investment into a retirement fund worth over $1 million. Remember, the Foundation ETF isn't where you go hunting for massive gains. It's where you plant the seeds that grow into trees, slowly, steadily, predictably. So if you're someone who wants solid long-term growth, reliable dividend payouts, and a totally passive way to invest, this is it, the cornerstone. But I'm not stopping here. In the traditional Boglehead model, the next piece would be bonds, but I'm flipping the script and replacing bonds with something that's a whole lot smarter. You see, bonds used to be the safety net of any solid portfolio. Their job was to protect you when the market got rocky, give you a bit of steady income, and balance out the risk from stocks. And back then, that made a lot of sense. But times have changed. Today, bond yields are low. Inflation eats away at your returns, and if you're in your 20s, 30s, or even 40s, you need more than just safety. You need growth. That's why in this updated strategy, I'm replacing traditional bonds with something that does everything bonds were supposed to do, but better: a dividend ETF. Dividend ETFs give you income just like bonds, but they also give you something bonds usually don't: growth. These funds invest in companies that share their profits by paying out regular dividends, and a lot of those dividends, they grow year after year. Plus, unlike bonds, the actual value of the ETF can rise over time too. So now you're building wealth in 2 ways: steady payouts and rising share prices. That's a win-win. The ETF I recommend here is the First Trust Dividend Strength ETF, ticker FDTS. This fund focuses on high-quality U.S. companies with strong fundamentals and a history of solid, growing dividend payments. It's like owning a basket of reliable income machines without the stress of managing individual stocks. And FDTS has the track record to back it up. It's paid dividends for 16 straight years and increased them for the last 3. That kind of consistency makes it an ideal upgrade from traditional bonds. Now let's look at the metrics behind FDTS. Dividend yield is 1.99%, the average annual return is 6.78%, and dividend CAGR is 13.42%. Let's say John continues his strategy of investing $10 a day, the same as with SPLG, and reinvests every dividend from FDTS. Here's what that looks like. After 10 years, his FDTS investment will be worth around $56,719. Stay on track for 20 years, and it'll be about $239,369. And if John commits for 30 years, his portfolio will be sitting at $1,189,099. Keep in mind, John only invested $108,000 total over 30 years. Of the total value added of $1,081,099, $629,169 comes from reinvested dividends, and $451,930 from the share price appreciation over time. Unlike bonds, dividend ETFs like FDTS also benefit from rising interest rates. So when rates go up, many dividend-focused stocks become more attractive, not less. That helps buffer your portfolio and keeps the income flowing. But this isn't just about math, it's about mindset. Too many investors see bonds as a must-have because they were always told to have them. But in a high-growth, high-dividend ETF like FDTS, you're not sacrificing safety, you're upgrading it. You're earning income that grows. You're investing in companies that also increase share price. And you're avoiding the slow crawl of bond returns that barely outpace inflation. Let's put this into perspective. If John had stuck with a traditional bond ETF offering 3% annually, his 30-year portfolio might have landed somewhere around $175,000 to $200,000, tops. By switching to FDTS, he ends up with nearly 6 times that amount. And just like with the Foundation ETF, this one works best when left alone. Don't panic during down years. Don't swap it for the next trendy fund. Just keep investing and let compounding do its work. Okay, so far we've secured growth through SPLG and layered on strong growing income through FDTS. Now let's go for the final piece of the puzzle, the ETF that adds explosive potential and pushes your portfolio into high gear. Traditionally, the third leg of the Boglehead 3-fund portfolio was international stocks. The logic is simple: diversifying beyond the U.S. economy and reducing your risk by investing in companies across Europe, Asia, and emerging markets. But here's the problem: international markets have underperformed U.S. markets for years. And even more important, today's biggest U.S. companies already have global reach. Apple sells iPhones in China. Microsoft runs data centers across Europe. Google, Amazon, Meta, they operate in every major country in the world. So if you're investing in these giants through a US-based ETF, you're already getting international exposure just without the lagging performance. So instead of playing defense with traditional international funds, let's aim for something more aggressive, more future-focused, a growth ETF. And for this, I'm talking about the Technology Select Sector SPDR Fund, ticker XLK. This ETF gives you access to the biggest and boldest U.S. tech companies, the same ones that have fueled most of the S&P 500's gains over the past decade. Now, XLK isn't your typical dividend ETF. It's not about consistent income, it's about serious long-term capital growth. But even so, it has paid dividends for 16 consecutive years and increased them for the last 3 years. That means you're still getting some income while riding the wave of massive growth potential. It has a dividend yield of 0.67%, which on average grows by 7.74% each year. But most importantly, it has an average share price appreciation of 18.27%. So let's run the numbers again with John investing $10 a day in this ETF. After 10 years, it'll be worth $87,331. Stick with it for 20 years, and it'll be around $559,531. And at the 30-year mark, his portfolio will be an incredible $3,093,876. That's with the same total contribution, just $108,000 over 30 years. The rest is pure growth. And remember, he only contributed $108,000 in total. About $2,976,761 will be from capital appreciation, and around $9,116 will be from reinvested dividends. That's nearly $3 million in value added just from staying consistent and trusting the long game. Now, yes, tech is volatile. It doesn't go up in a straight line. There will be dips, there will be corrections, but if your investment horizon is 10, 20, 30 years, few sectors can touch what tech has delivered. That's why XLK isn't just a fun bonus, it's a critical part of this modern 3-fund portfolio. It pushes the growth curve higher. It gives your portfolio explosive upside. So now you've got the full setup, a simple, powerful portfolio designed for today's world. Here's how the overall portfolio breaks down. Still simple, but now even more strategic. And I'm including one backup ETF per category for your consideration. For your foundation, you've got SPLG, a low-cost ETF that tracks the entire S&P 500. And if you want a similar option with a bit more liquidity, there's SPY, which does the same job with slightly higher fees. For income, I recommend FDTS for its strong dividend growth. But if you're leaning more toward higher yield and consistency, SCHD is a fantastic addition here. Solid companies, steady payouts, and a great track record. And for growth, XLK is your access pass to the biggest names in tech. But if you want to take it a step further and tap into the future of semiconductors, SOXX gives you direct exposure to that booming sector. For this video, I've selected SPLG, FTDS, and XLK for the overall portfolio. Now, to calculate the portfolio's investing metrics. To calculate the dividend yield of the entire 3 ETF portfolio, I use a simple average based on equal weighting. Each ETF, SPLG, FTTS, and XLK has its own forward dividend yield, SPLG at 1.28%, FTTS at 1.99%, and XLK at 0.67%. Since this portfolio assumes equal distribution across all three, I added those three yields together and divided by 3. The math looks like this: 1.28 plus 1.99 plus 0.67 divided by 3 equals 1.31%. You can do the same for dividend growth and average share price appreciation. Put it all together and this modern 3-fund setup delivers some pretty impressive numbers. Combined dividend yield of 1.31%, dividend growth rate of 9.46%, and average annual return of 11.92%. But what do all these numbers really mean for your future? That's the part that matters most, and now we get to see what happens when these 3 ETFs come together and work as a team. You don't need 10 different funds, just these 3 core ETFs. One for growth, one for income, one for stability, and maybe a backup or 2 if you want to tweak things down the road. Together, they cover everything you need: solid returns, regular dividends, and the peace of mind that comes from a well-balanced strategy. So let's say John sticks with the plan. He invests $10 a day, around $300 a month, into this portfolio. He reinvests every single dividend and doesn't touch a thing, just stays consistent. After 10 years, his portfolio will be worth about $66,471. In 20 years, that number will grow to around $288,104. And by the 30-year mark, John's investment will have become a total of $1,012,086. Out of that total, about $53,644 will come directly from reinvested dividends. The other $850,442 is pure capital appreciation. So in the end, the total value added to John's portfolio will be an incredible $904,086, all from staying the course and letting his 3 ETF strategy do its thing. This portfolio isn't one size fits all. You can shape it to match your goals, timeline, and risk tolerance. Want faster growth? Put more weight on XLK or SOXX, the growth ETFs. They're more volatile, but over decades, they've delivered massive returns. Need more passive income? Lean heavier into FDTS or SCHD. These dividend ETFs pay you regularly and their payouts grow year after year. Prefer stability and slow, steady gains? Well, then allocate more to SPLG or SPY. These foundation ETFs track the market broadly and keep your portfolio grounded. The key is this: keep your structure simple, stay consistent, and let time do the heavy lifting. The $92,000 Roth IRA mistake to avoid. What if your Roth IRA was costing you $92,000 and you didn't even know it? Well, it's happening to millions of Americans right now through simple everyday mistakes that seem harmless until it's too late. And no, this isn't some obscure tax code loophole, just everyday mistakes that look harmless now but quietly cost you big later. In this video, I'm going to walk you through 10 of the most expensive Roth IRA mistakes people make, often without realizing it. For each one, I'll break down exactly what the mistake is, why it happens, how much it could cost in dollar amounts, and most importantly, how to avoid it. In the end, I'll show you how all these mistakes add up to over $92,000 without you even knowing it. Before I show you that, let's quickly break down what a Roth IRA and traditional IRA actually are, because the differences matter more than you think. A traditional IRA is like a tax-deferred piggy bank. You put money in, usually get a tax break up front, and your investments grow over time. But when you retire and start pulling the money out, that's when Uncle Sam comes knocking. Every withdrawal is taxed as income. Now, a Roth IRA flips the script. You pay taxes now before you put money in, but then your investments grow tax-free. And the best part? When you withdraw in retirement, you keep every penny. No taxes, no surprises. Both accounts help you save for retirement, but the when and how you're taxed can change your future in a big way. Now let's create a simple scenario that'll help you and John avoid the $92,000 loss. Let's say John is in his 40s. He's been disciplined about saving and now has $100,000 sitting in his retirement account. It's a mix of Roth IRA and traditional IRA dollars, and he's planning to let it grow for the next 20 years. But here's the thing, how John manages this $100,000 today will determine whether he retires with $386,000 or far less. Every decision he makes along the way, contributions, rollovers, withdrawals, has the power to either build his wealth or quietly erode it. So let's walk through 10 costly Roth IRA mistakes that John and possibly you need to avoid, because doing so could protect up to $92,000 of potential gains and savings on that same $100,000. Let's talk about the biggest traps that could silently eat away at your retirement savings and how to avoid them smartly. Starting with number 10, thinking of your Roth IRA as mad money. Picture this, you've already maxed out your 401k, you've been watching CNBC, and now you're eyeing your Roth IRA like it's your playground for risk. Maybe you're tempted to throw your Roth into that new EV ETF, meme stocks, or even some shiny AI crypto coin someone mentioned on Reddit. After all, it's your extra money, right? That's the trap. While a Roth IRA may feel like a side hustle account, it's actually one of the most powerful long-term investment tools you've got. Contributions grow tax-free, and the compounding over decades can turn a few $1,000s into a six-figure treasure chest if you play it smart. Let's say John earns around $80,000, has saved around $100,000 in his Roth IRA, and invests it in a simple balanced portfolio averaging 7% over 20 years. He'd end up with about $386,000, and remember, it's all tax-free. But what if John gets overconfident and treats his Roth like a sandbox for risky bets? Maybe he loads up on speculative crypto, meme stocks, or trending sectors with wild volatility. That kind of misallocation, even if it only drags his average return down to 5.5%, could leave him with just $292,000. That's a difference of $94,000. We'll conservatively say John loses $4,600 in future growth just from this behavioral mistake alone. By misallocating funds or treating your Roth like a tool for gambling, you risk sabotaging one of the only tax-free growth vehicles available to everyday investors. A target date fund, broad market ETF, or balanced portfolio might sound boring, but boring builds wealth. If you structure your Roth IRA with core, diversified holdings from the start, you're stacking the odds in your favor. This mistake alone can easily cost you $4,000 to $5,000 over time in lost growth or bad investment calls. And here's the irony. Those risky plays, you can do those elsewhere. But in a Roth IRA, that's where your most dependable, long-term, tax-free compounding should be happening. So if you're tempted to YOLO your Roth IRA into niche crypto tokens, stop and ask yourself, is that really where you want your tax-free wealth engine going? Moving on to number 9, not planning for the second half of retirement. When you think about retirement savings, it's easy to obsess over one question: how much can I save? But saving is only half the game. The second half? That's all about withdrawing your money wisely. And not having a plan for that phase could wipe out thousands in avoidable taxes. Let me explain. When you stash your cash in a traditional IRA, you get that sweet upfront tax deduction, but at a cost. You're deferring taxes until you withdraw, and in retirement, your withdrawals are taxed as income. Now, many people assume that they'll be in a lower tax bracket later, but with national debt climbing past $36 trillion and U.S. tax rates still near historical lows in 2025, what if your future tax rate is higher, not lower? That's the issue. Most people only plan for the accumulation phase, growing the pot. But the distribution phase can be just as financially dangerous if you're not prepared. Let's get back to John with his $100,000 in a traditional IRA. He's focused on growing it, but he hasn't given much thought to how he'll take money out in retirement. Here's where things go sideways. If John simply starts withdrawing at retirement without a tax plan, he could end up paying 22% in taxes on each dollar, losing about $22,000 in total over 20 years. But what if John had a Roth IRA too and used a smart withdrawal strategy, blending distributions or doing partial conversions now? He could shrink that tax bill significantly. By planning the second half of the journey, not just the saving part, John realistically saves $4,000 in taxes on the same $100,000. Roth IRAs solve part of this problem because those withdrawals, they're tax-free. But to benefit, you need to start planning early. Ideally, you should have a tax-smart mix, some traditional, some Roth. So when the time comes, you can pull money in a way that keeps your tax bill low. Number 8 on today's list of mistakes, converting to a Roth all at once. So you've realized the Roth IRA is your golden ticket to tax-free income, and now you're thinking I should convert my entire traditional IRA into a Roth right now. That's a bold move, but potentially a very expensive one. See, Roth conversions can be smart, especially if you expect your income and tax rates to rise in the future. But converting a big chunk of money in a single year could throw you into a higher tax bracket and trigger a massive tax bill. Now, John's thinking, why not just convert my whole traditional IRA into a Roth right now? He wants future tax-free income, which is smart, but doing it all in 1 year adds $100,000 to his taxable income. That pushes John from the 12% bracket into the 22% range. Because before moving the funds, he was earning around $80,000, which fell under the tax bracket of 12%. Now, moving the whole amount is considered a withdrawal first, meaning for the year, his taxable income would be $100,000, that withdrawal, plus $80,000 in income. So his total income for the year would be $180,000, and hence the 22% tax bracket, and around $30,000 in taxes. Had he converted $16,000 per year over 5 years, he could have stayed in the lower bracket, paying around $12,000 in total taxes. That's an $18,000 difference. But here's where people get it wrong. You don't have to go all in. You can do it gradually. The IRS lets you do partial conversions every year. You can convert $16,000 per year instead. That keeps you in a lower bracket, spreads the tax bill, and slowly shifts your money into tax-free territory without torching your current finances. This laddering approach can save you so much in tax costs compared to a full one-time conversion. Plus, you still get the benefit of long-term tax-free growth. And if the market dips, your account value goes down, and that's actually the perfect time to convert. Why? Because you're paying taxes on a temporarily lower value. And when the market rebounds, all those gains happen inside your Roth untouched by the IRS. In short, don't be in a rush to convert everything at once. A smarter, smaller, strategic Roth conversion plan gives you the best of both worlds: controlled taxes now and full freedom later. Number 7 on our list is breaking the rollover rules. Okay, now let's talk rollovers, specifically the kind of mistake that can blindside even seasoned investors. Here's the scenario. You switch jobs, you've got a 401k at your old workplace, and you want to move that money into an IRA. Sounds simple, right? But here's where the IRS has a little trap. There's a rule that says you can only do one IRA to IRA rollover per 365 days. That's not one per IRA, that's one rollover total across all your IRAs. Do two, even by accident, and boom, you've just triggered a tax bomb. Let's play with John's money to better understand this. So he decides to move money from one of his IRAs to another after a job switch. He thinks it's simple, just roll it over manually. But he doesn't realize the IRS only allows one indirect IRA to IRA rollover per year across all IRAs. He does it twice. Oops! The second transfer, the IRS treats as an early $20,000 withdrawal. As we mentioned earlier, let's say John is earning around $80,000. The extra $20,000 withdrawal will push him to the 22% tax bracket. Now, John owes 22% income tax on it, $4,400, plus a 10% early withdrawal penalty of $2,000. That's $6,400 down the drain just because of a timing rule. Now, here's the trick to avoid all that. Do a direct transfer, not an indirect rollover. A direct transfer means the money goes straight from one account provider to another. No check in your hands, no risk of messing it up. And direct transfers aren't subject to that one per year rule. The problem is, a lot of people don't know this. They think all rollovers are treated the same and they end up getting burned. Don't be one of them. Knowing the rollover rules isn't optional, it's a requirement for protecting your savings. So if you're making changes to your IRA, always ask, is this a direct transfer? If not, pause, because even a single mistake here can cost thousands, and the IRS rarely gives do-overs. Okay, so far we've saved about $33,000 in taxes. In the next few steps up to number 1, I'll show you and John how to avoid mistakes that could save a combined total of over $92,000. Number 6 on our list of mistakes, rolling over the money yourself. Now, let's say you're doing a rollover and the check is made out to you. You think, oh cool, I'll just move it to my new IRA when I get around to it. That's a big mistake. Here's why. If you take possession of that money, even just for a day, you've triggered an indirect rollover, and that comes with serious risk. You only have 60 days to get that money into your new IRA, or the IRS treats it as a withdrawal. And if you're under 59 and a half, you're now looking at income taxes plus a 10% early withdrawal penalty. Let's break that down. John does a rollover, but the check is made out to him personally. He gets distracted, life happens, and forgets to deposit it into his new IRA within the IRS's 60-day window. So now, that full $100,000 is treated as a distribution. He owes $22,000 in income taxes and $10,000 in early withdrawal penalties on this alone. That's a catastrophic $32,000 hit. Even if John catches it and redeposits a partial amount, missing the window even once could still cost him thousands. Let's say he delays with $15,000 of the transfer and pays around $3,800 in taxes and penalties. That's still a preventable loss. And here's the worst part, some people use that money temporarily. They basically borrow it for a big purchase or an emergency, thinking they'll pay it back before the 60 days are up. But life happens, and suddenly that repayment money isn't there when it needs to be. So if you absolutely must do an indirect rollover, you need to be extremely careful. Document everything. Track the date the money hits your account and set reminders to get it transferred correctly within the window. But honestly, just avoid the risk altogether and go with a direct rollover. That simple switch, letting the financial institutions handle the transfer, can save you thousands in surprise taxes and penalties. It's one of those boring but brilliant moves that keeps your retirement plan safe. So now collectively, avoiding this mistake along with the last one, you're looking at $8,000 to $9,000 saved, maybe more, depending on how much you're transferring. Avoidable mistake number 5, another tax trap, Roth conversions and the pro rata rule. Now let's look into one of the sneakiest traps in the Roth conversion playbook, something most people don't learn about until it's too late, the pro rata rule. If you've got a mix of pre-tax and after-tax money in your traditional IRA, the IRS doesn't let you cherry pick and just convert the after-tax portion tax-free. No, they look at your entire IRA balance when calculating how much the conversion is taxable. Let me explain further here. John hears about backdoor Roth conversions and decides to convert $10,000 of after-tax money from his traditional IRA, but there's a catch he doesn't see coming. His IRA also contains $90,000 of pre-tax money, and thanks to the pro rata rule, the IRS doesn't let him convert just the after-tax portion tax-free. Instead, the IRS sees it all as one big account. So when John converts $10,000, only 10% is after tax and tax-free. The remaining $9,000 is considered pre-tax and now taxable. With his income already at $80,000, that $9,000 pushes him to $89,000 in taxable income, which still keeps him within the 12% tax bracket for 2025. So instead of a free conversion, he now owes $1,080 in taxes just on this move alone. And if he keeps converting more without restructuring his accounts, that tax bill adds up fast, $3,000 to $4,000 or more over time. So what's the solution here? If you're planning a backdoor Roth conversion, try to do it when you have no pre-tax IRA balance. That may mean rolling your traditional IRA into a 401k, which doesn't count towards the pro rata calculation, before doing the conversion. It's a bit of a dance, but getting it right could save you $4,000 to $6,000 or even more, depending on your IRA size and tax bracket. That's money you keep working for you instead of handing it over in taxes. Okay, you've now seen 6 major mistakes that, if avoided, can conservatively protect $50,000 to $60,000 plus in long-term savings and tax advantages. And I'm not done yet. In the next 4 mistakes, I'll show you how you can save upwards of $20,000 to $30,000. The number 4 mistake, ignoring QCDs, or qualified charitable distributions. Let's talk about a tax-saving hack that sounds too good to be true but is 100% real. It's called a QCD, or Qualified Charitable Distribution. And if you're 70 and a half or older, this could be one of the best-kept secrets in retirement planning. If you're taking money out of a traditional IRA and you're also feeling charitable, you can donate up to $100,000 per year directly from your IRA to a qualified nonprofit, and that donation, it doesn't count as income. Normally, when you withdraw from a traditional IRA, that money is added to your taxable income for the year, but with a QCD, the IRS essentially looks the other way. You don't get a deduction, but you get something even better. You exclude the amount from your income altogether. That lowers your taxable income, possibly reduces your Medicare premiums, and even helps you avoid higher tax brackets. Now here's the part most people miss. This QCD also counts towards your required minimum distribution, or RMD. So instead of pulling out money you don't need, paying taxes on it, and then donating it, you just send the money directly from the IRA to the charity. No taxes, no paperwork headaches, just a cleaner, smarter way to give. Okay, let's get John back into the picture. He's now 71 and feeling generous. He donates to charity every year, but he's doing it the hard way, taking money out of his traditional IRA, paying taxes on it, and then making donations. If John simply directed the donations straight from his IRA through a qualified charitable distribution, that money wouldn't count as income. No taxes, no paperwork headaches. Let's say he donates $8,000 per year and misses this for just 5 years. That's about $960 per year in taxes at his 12% rate, nearly $4,800 wasted. Let's be conservative and say John could have saved $3,700 in taxes over a few years with QCDs. But more than that, ignoring QCDs for a few years, that adds up. Many retirees lose $5,000 to $7,000 over just a few years by not using this strategy. And the best part? You don't need to itemize deductions. Even if you take the standard deduction, which most people do after age 65, you can still benefit from QCDs. It's like getting a custom tax loophole built just for retirees who want to give. So if you're approaching 70 and a half or know someone who is, this is a strategy worth planning for now. Future you and your favorite nonprofit will thank you. Moving on to mistake number 3, contributing too much. Now let's switch gears and talk about another mistake, putting in too much money. And yes, this is actually a problem. Every year, the IRS sets strict contribution limits for Roth IRAs. For 2025, you can contribute up to $7,000 if you're under the age of 50 or $8,000 if you're 50 years of age or older. But it's not just about the dollar amount. You also need to meet income eligibility. If your income is too high, your contribution limit starts to phase out. And if you make too much, you can't contribute at all. In 2025, the phase-out begins at $146,000 for single filers and $230,000 for married couples filing jointly. Now here's where it gets messy. If you accidentally contribute too much either by dollar amount or by ignoring those income limits, you face a 6% penalty every year on the excess contribution. That might not sound like much, but it adds up fast. Let's say John gets a bonus at work, throws extra money into his Roth IRA, everything looks great. Sounds good, except he forgot the income limit. His adjusted gross income was too high, and now he's over-contributed. The IRS hits him with a 6% penalty on the excess every year it stays in the account. Let's say he mistakenly contributes $3,000 too much and doesn't notice it for 3 years. That's $540 in penalties and possibly taxed growth on top of that. If he misses this for multiple years or keeps doing it, it adds up fast. Let's assume a fair cost here of $3,500 in penalties and lost earnings. Many people don't notice this mistake for years, and suddenly they've paid over $1,000 to $2,000 in penalties, all for a few $100s over the line. And this usually happens to people who are trying to do the right thing. Maybe your income increased unexpectedly. Maybe you got a year-end bonus. Maybe you just miscalculated. The fix? Stay aware of the income limits and contribution caps every year. And if you do go over, fix it quickly. Withdraw the excess before the tax deadline and avoid carrying those penalties forward. Getting the details right can save you thousands in long-term penalties and makes sure your money stays invested, not penalized. The number 2 mistake on our list is missing out on a spousal IRA. If you're married and only one of you earns an income, here's a simple question. Are you missing out on an extra $7,000 to $8,000 per year in tax-advantaged savings? Because that's exactly what happens when couples overlook the spousal IRA rule. Normally, to contribute to an IRA, you need earned income, but there's one major exception. If you're married and file jointly, the working spouse's income can cover contributions for both of you. That means even if one spouse doesn't work outside the home, they can still have a fully funded IRA in their own name. Let's say John's wife isn't working this year and they file taxes jointly. He contributes to his Roth IRA but forgets he can also fund a spousal IRA for her, even though she has no income. That's another $7,000 per year they could be investing tax-advantaged. Over 10 years, that missed contribution would have grown to around $100,000 with average returns of around 7 to 8%. Even at just 5% growth, it's nearly $90,000. John may have lost an opportunity worth 6 figures, but to stay consistent, we'll assign a conservative cost of $4,100 in lost tax-free compounding. And remember, each IRA is owned individually. That means your spouse can choose their own investment strategy and you can optimize both accounts in different ways. Maybe one is more aggressive, one more conservative. It's a simple move with massive upside, and yet it's commonly overlooked. Don't leave half your retirement potential on the table. Finally, our number one mistake is misunderstanding inherited IRA rules. Let's wrap this up with one of the most emotionally and financially charged mistakes. What happens when you inherit an IRA? Whether it's from a parent, spouse, or other relative, inherited IRAs come with their own set of rules, and misunderstanding them can trigger massive, unnecessary taxes or even IRS penalties. Here's what most people don't realize. You can't just treat an inherited IRA like your own. The rules depend on your relationship to the deceased. If you're a surviving spouse, you can roll the IRA into your own and treat it like any other retirement account. But if you're a non-spouse beneficiary, things get more complicated fast. Under the current rules, most non-spouse beneficiaries must fully deplete the inherited IRA within 10 years. That's the 10-year rule. And while you don't need to take required minimum distributions each year, you must empty the entire account by the end of that decade. Here's the problem. If you wait until the last year to withdraw everything, that lump sum will count as income in that year. And if the account is large, let's say John inherits a $100,000 IRA from a relative, instead of slowly withdrawing funds over 10 years as allowed, he waits until year 10 and pulls the full amount in one go. That $100,000 hits his income all at once, bumping him into a high tax bracket, and he ends up paying 22% or $22,000 in taxes. If he had spread withdrawals out, his tax bill could have been closer to $10,000 to $12,000 or none in the most efficient case. So let's recap 10 Roth IRA mistakes and how much they could cost if left unchecked. Treating your Roth like mad money? That's $4,600 lost. Not planning withdrawals smartly? Another $4,000. Going all in on a Roth conversion? Up to $18,000 in unnecessary taxes. Breaking rollover rules? That's $6,400 gone. Missing the 60-day rollover window? A brutal $32,000 hit. Ignoring the pro rata rule? Easily $4,000 in surprise taxes. Skipping QCDs? $3,700 wasted. Over-contributing? $3,500 in penalties. Forgetting the spousal IRA? That's $4,100 in lost growth. Mishandling an inherited IRA? Up to $12,000 in avoidable taxes. That is a combined total of around $92,200, real money, real mistakes, and all preventable with the right guidance. 10 SCHD mistakes people make. Everyone says SCHD is a safe, set-it-and-forget-it investment, but that's not the full story. Yes, SCHD is an excellent dividend ETF, but if you blindly invest in it without a strategy, you could be leaving massive returns on the table or even hurting your financial future. Most investors assume that because SCHD pays high dividends and has a strong track record, they don't need to do anything else. But that mindset can lead to costly mistakes. Mistakes that could slow your portfolio's growth, limit your passive income, and put you behind on your financial goals. In this video, we'll break down the 10 biggest mistakes people make with SCHD and why most investors are using it wrong. I'll show you how you can avoid all these, and in the end, I'll show you how much daily investment, spoiler alert, it's in single digits, you need to retire with a portfolio close to $1 million that pays over $70,000 in annual dividends, which equates to over $5,000 in monthly dividend income. Before that, let's start with one of the biggest mistakes investors make when it comes to SCHD, and that is getting overly excited about its high dividend yield. At first, it seems like free money. After all, SCHD offers a yield of 3.55%, which is 27.75% higher than the median yield of other ETFs at 2.78%. That sounds fantastic, right? But here's the catch. Focusing only on dividend yield can lead you down the wrong path. A high yield might look attractive in the short term, but it doesn't always mean the investment is solid in the long run. When investors chase high yields, they often ignore an equally important factor: dividend sustainability. Just because a company or fund offers a high dividend today doesn't mean it'll continue to do so in the future. Companies in SCHD might face economic challenges, and if they struggle financially, they could cut or reduce their dividends. This would not only decrease your income, but also hurt the value of your investment. Another common mistake is ignoring dividend growth. Many people get so focused on the current yield that they forget to consider whether those dividends are actually growing. Luckily, SCHD shines when it comes to dividend growth. Its dividend growth rate for the last year is 12.23%, compared to the median ETF's 7.74%. Over the past 5 years, SCHD's dividends have grown at an impressive 11.59% CAGR, while the average ETF only manages 4.77%. So while SCHD's yield is strong, the real value lies in how consistently those dividends grow over time. Let's put it into perspective. Imagine you earn $100 in dividends this year. If your dividends grow at 11.59% annually, you'll be earning around $170 in just 5 years. But if you're only focused on the high yield and ignore growth, you might end up stuck with a fund that pays a lot now but doesn't increase over time. Over the long run, growing dividends can give you much more income than a flat, high-yielding dividend. So, mistake number 1 was all about chasing high yields without considering sustainability. But here's an even bigger risk: believing SCHD is a completely safe investment. That false sense of security can cost you thousands. Just because a stock or ETF pays dividends doesn't mean it's immune to market downturns. Companies can face tough times, and if their profits fall, they might reduce or stop paying dividends altogether. SCHD has a strong history. It's grown its dividends for 13 consecutive years, which is far better than the average ETF that manages just 1 year of growth. But even with this strong record, markets can change, and assuming SCHD is completely safe is a risky mindset. Even if you understand SCHD isn't risk-free, many investors still fall into a dangerous trap trying to time the market instead of sticking to a proven strategy. This mistake leads to lower returns and missed opportunities. This means they attempt to guess the perfect time to buy or sell, thinking they can snag shares at the lowest price and sell at the peak. It sounds like a smart strategy, but the truth is even professional investors struggle to predict the market consistently. More often than not, trying to time the market leads to missed opportunities and lower overall returns. So instead of trying to predict market movements, a better approach is to invest consistently over time. This means contributing to your SCHD investment regularly, whether it's monthly, quarterly, or with every paycheck, regardless of what the market is doing. This strategy is known as dollar cost averaging. When prices are low, your money buys more shares, and when prices are high, it buys fewer. Over time, this averages out your purchase price, reducing the risk of making a big investment at the wrong time. Okay, so you now know that timing the market is a losing game, but what if I told you that one simple decision, reinvesting your dividends, could grow your portfolio nearly 5 times more than just collecting payouts? Most investors ignore this, and they pay the price. While it might feel rewarding to receive regular cash payouts from dividends, simply letting that money sit in your account or spending it means you're missing out on one of the most powerful tools in investing, which is compounding. Reinvesting dividends means using the income from those payouts to buy more shares of SCHD. Over time, these additional shares also generate dividends, creating a snowball effect where your investment grows exponentially. Let's break this down with some real numbers. Suppose you invest $10,000 in SCHD and decide not to reinvest your dividends. After 30 years, your portfolio would grow to around $97,056. That's still a decent return, but here's where the magic of reinvesting dividends comes in. If you reinvested those dividends instead of taking them as cash, your $10,000 would grow to an impressive $464,215 after the same 30 years. That's almost 5 times more wealth, all thanks to the power of reinvesting. Why is there such a huge difference? Well, it's because each time you reinvest your dividends, you're buying more shares of SCHD. These new shares then start earning dividends as well, and over time, this cycle repeats itself, accelerating your portfolio's growth. Without reinvesting, you're only earning dividends on your original shares. But with reinvestment, your dividends are constantly working for you, helping your investment grow much faster. Now, in the end, I will show you how to use this strategy to invest just what a daily coffee costs and retire with a portfolio close to $1 million that pays over $5,000 in monthly dividend income. Okay, so we've seen how important it is to keep your dividends working for you. Let's move on to another mistake that can trip up even experienced investors: ignoring SCHD's underlying holdings. One of the biggest mistakes people make when investing in SCHD is not paying attention to what's actually inside the fund. SCHD is an ETF, which means it holds a collection of different stocks, but that doesn't mean it's automatically diversified the way you might think. Many investors assume that buying an ETF like SCHD spreads their risk across all sectors evenly, but that's not always the case. Without understanding the specific companies and sectors SCHD is invested in, you could be exposing yourself to risks you didn't even realize. For example, SCHD is heavily weighted in certain sectors. Financials make up 18.85% of the fund, and industrials account for 11.35%. This means if there's a downturn in the financial sector, like a banking crisis, SCHD could take a bigger hit than other ETFs that are more evenly spread across different sectors. The same goes for industrials. If the economy slows down and companies cut back on building and manufacturing, SCHD's industrial holdings could suffer, dragging down the entire fund. Failing to understand the underlying holdings means you're investing blindly. You might think you're diversified because SCHD holds over 100 companies, but if many of those companies are in the same sectors, you're not as diversified as you think. And that leads to the next common mistake: not diversifying beyond SCHD. While SCHD is a solid fund with a strong focus on dividend-paying companies, relying solely on it can limit your investment potential. A lot of people fall into the trap of thinking that because SCHD holds over 100 companies, they're fully diversified. But here's the thing: SCHD only invests in U.S. companies that pay dividends. That means you're missing out on other important areas of the market, like international stocks or high-growth technology companies that don't pay dividends. For example, SCHD has only 10.22% of its holdings in the technology sector. But technology is one of the fastest-growing sectors in the world. Companies like Amazon and Google, which are major drivers of market growth, don't pay dividends, so they're not included in SCHD. If you only invest in SCHD, you could miss out on the massive growth potential of these types of companies. So a good rule of thumb is you also add a couple of solid stocks alongside SCHD to your portfolio. But even if you diversify, there's still another factor many investors overlook. A mistake that flies under the radar for many SCHD investors is ignoring the fund's rebalancing schedule. Rebalancing is when the fund adjusts its holdings to stay aligned with its investment strategy. SCHD rebalances quarterly, which means every 3 months the fund makes changes by selling some stocks and buying others based on specific criteria. Why does this matter? Well, if you're not paying attention, these changes can catch you off guard.
For example, a company you really liked that was in SCHD might get removed if it no longer meets the fund's standards for dividend growth or financial stability. On the flip side, SCHD might add a company you didn't expect, which could shift the fund's sector exposure or risk profile. SCHD doesn't just make random changes during its quarterly rebalancing, it follows a specific set of rules to ensure it continues to meet its investment objectives. Here's how it works. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which is made up of 100 high-quality U.S. companies with strong dividend-paying histories. To stay in the fund, companies must meet 3 criteria. Companies must have consistently paid dividends for at least 10 consecutive years. Companies are evaluated based on financial metrics like return on equity, dividend yield, dividend growth rate, and free cash flow to debt ratio. Lastly, the fund looks for companies that are not only paying dividends but are also likely to continue and grow those dividends in the future. Then every 3 months, SCHD adjusts the weight of its holdings to ensure no single company dominates the fund. This helps maintain diversification and reduces risk. And once a year, the fund does a deep review of its entire portfolio, removing companies that no longer meet its strict criteria and adding new companies that qualify. This is when you'll see the most significant changes in the fund's composition. Also, SCHD ensures that no single sector dominates the fund. This prevents overexposure to industries that might be performing well now but could face downturns in the future. For example, no single sector can make up more than 25% of the total fund, and no individual stock can exceed 4 or 4.5% of the portfolio at the time of rebalancing. While SCHD is focused on dividend yield, it doesn't just chase the highest yielding stocks, it also screens for quality, meaning companies must show strong financial health and the ability to sustain their dividends over time. This balance between yield and quality helps reduce the risk of investing in companies that might cut their dividends in the future. Ignoring these rebalancing changes can lead to surprises in your portfolio. Let's say SCHD removes a company that paid a large dividend. You might notice that your dividend income drops, and if you weren't aware of the rebalancing, you might not understand why. Or if SCHD adds a company with a strong growth potential but a lower dividend, your portfolio might grow faster in value, but you'll receive less income in the short term. While it's important to stay informed about SCHD's rebalancing, you also shouldn't get distracted by the excitement of individual stocks during a bull run. It's easy to feel tempted to pull your money out of SCHD when you see other stocks skyrocketing, but that short-term thinking can hurt your long-term strategy. And that brings us to the next common mistake: confusing SCHD with individual stocks. So a comment on one of our videos from one of our followers mentioned Tesla is up 32,795.31%, the trillion-dollar gorilla in the room. Look, while Tesla's explosive growth is undeniably impressive, comparing it directly to SCHD doesn't really make any sense because they're two very different types of investments. SCHD is designed to give investors exposure to a diversified basket of dividend-paying U.S. companies. This diversification helps reduce risk because your money isn't tied to the performance of just one company. If one company in the fund struggles, the other companies can help balance it out. On the other hand, buying a single stock like Tesla means you're putting all your money into a single company. And while Tesla has experienced massive growth, it's also been extremely volatile. Its price can swing wildly up or down based on news, earnings, or even Elon Musk's tweets. With individual stocks, you face the risk of losing a significant portion of your investment if something goes wrong with that specific company. Investors looking for quick, massive gains might be drawn to high-growth stocks like Tesla, but this comes with a lot of risk. SCHD, by contrast, focuses on steady growth and reliable income through dividends. It won't skyrocket like Tesla, but it also won't crash as hard during market downturns. Comparing SCHD to a stock like Tesla is like comparing a family sedan to an F1 race car. One is built for steady, safe travel, while the other is designed for speed with a higher risk of crashing. This brings us to another mistake: focusing too much on short-term performance and ignoring the long-term potential of SCHD. It's easy to get caught up in how your investment's doing this month or even this year, but SCHD is built for the long haul. If you only look at short-term returns, you might think SCHD isn't performing well compared to other investments, and that could lead you to make some poor decisions. Let's take a look at the numbers. In the last month, SCHD had a total return of 1.87%, which is just slightly below the median for all ETFs at 2.26%. Over 6 months, SCHD's total return was 2.96%, which is 21.99% lower than the median ETF. If you only looked at these numbers, you might think SCHD isn't a strong investment. But here's where many people make a mistake. They don't zoom out to see the bigger picture. Over 3 years, SCHD has a total return of 18.27%, which is 22.58% higher than the median ETF. And over 5 years, SCHD's total return is a solid 74.93%, nearly double the median return of 37.73%. This shows that while SCHD might not always shine in the short term, it delivers strong, consistent returns over time. Remember, in the end, I will show you how you can invest just what a daily coffee costs and retire with a portfolio close to $1 million that pays over $5,000 in monthly dividend income. Now, possibly the worst mistake investors make with SCHD is not adjusting their strategy as they get older. When you're young and have 30 years until retirement, you can afford to take more risks because you have plenty of time to recover from any market downturns. But as you get closer to retirement, your focus should shift from growth to preserving your wealth and generating a steady income. Let's say you want to retire with a portfolio that pays $2,000 in monthly dividend income by the time you retire. Let's break this down with SCHD. If you start investing with $10,000 at age 30 and reinvest your dividends, your portfolio could grow to $464,215 by the time you retire at age 60 and pay around $2,000 to $3,000 per month. This growth comes from a combination of capital appreciation and reinvested dividends. At this stage in life, your primary goal is to grow your money as much as possible. But if you're only 10 years from retirement and need to build enough wealth to generate $2,000 per month in retirement income, you'll need to invest more aggressively. In this case, you might start with a $200,000 investment instead of $10,000. After 10 years with dividends reinvested, your portfolio could grow to $619,568. This larger starting amount helps you catch up, but the risk is higher because you have less time to recover from any potential market dips. Now, here's a little SCHD secret for building passive income without needing a massive upfront investment. You don't have to dump thousands of dollars into the market right away. In fact, by simply investing $7 a day in SCHD, you can steadily create a reliable income stream over time. All thanks to the power of dividend growth and compounding. Let's break it down. Suppose you start with zero initial investment and commit to adding $7 every day into SCHD. Even with this small contribution, your money doesn't just sit there, it works for you. SCHD offers a solid dividend yield of 3.55% and a strong history of dividend growth with a dividend CAGR of 11.04%. These dividends can be reinvested to buy more shares, which means you're earning returns not just on your original investment, but on the growing dividends as well. After 5 years, your $7 a day investment will grow to $16,156. Fast forward to 10 years and things start getting more exciting. Your total investment will be valued at $45,211. By the 20-year mark, your passive income is becoming more noticeable. Your total investment will be valued at $208,807.
After 30 years of contributing and reinvesting dividends, your portfolio would reach an impressive $938,235. You would have contributed only $76,650 out of pocket, and in return, you would get $442,328 in capital appreciation and $419,257 from reinvested dividends, adding to a total value added to your portfolio of about $861,585. Roth IRA versus 401k, $100,000 in. Which is better? Ever feel like every time you Google retirement savings, you end up more confused? Roth IRA, 401k, tax-free this, pre-tax that. What does it all mean? You're not alone, and the stakes couldn't be higher. Choosing the wrong account could mean paying more in taxes, losing out on free money, or watching your savings grow slower than they should. In this video, I'm breaking it all down for you and John, step by step. I will compare the Roth IRA and 401k, tackle their differences, and even run the numbers on a $100,000 investment. In the end, I'll show you and John a side-by-side comparison and show you which one is the best option for you. Both options have the potential to cross $1 million valuation, but one can save you an extra $100,000 in taxes. First, let's start with the Roth IRA and its basics. A Roth IRA is a special type of retirement account that helps your money grow tax-free. Here's how it works. The money you put in has already been taxed. So when you take it out in retirement, you don't owe any taxes on your withdrawals. Compare that to a traditional IRA where you get a tax break now but pay taxes later when you withdraw your money. The Roth IRA flips that around, which can be a game changer for your long-term savings. Why is this such a big deal? Well, it's simple. When you retire, your fund will have grown larger, meaning you'll fall into a higher tax bracket. Paying taxes now while you're in a lower bracket means you're avoiding getting taxed at higher brackets later on. With a Roth IRA, you don't have to worry about paying higher taxes on your hard-earned savings because you've already handled the taxes when you contributed. It's all about planning ahead. Now, of course, there are a few rules you need to follow. First up, your income needs to fall below a certain level to contribute. In 2025, if you're single, you can contribute the full amount if you earn less than $150,000. For married couples, the limit is $236,000. If your income is higher than these amounts, your ability to contribute starts to phase out. But don't worry, there's a way around that, which I'll cover in just a moment. The next important rule is the annual contribution limit. In 2025, you can contribute up to $7,000 each year, or $8,000 if you're 50 or older. This limit is adjusted occasionally, so it's always a good idea to keep an eye on updates. Remember, with the Roth IRA, the contributions you make are not tax-deductible on your tax returns, but the trade-off is well worth it because of the tax-free growth and withdrawals later on. But it isn't just limited to that. Different types of Roth IRAs also offer good opportunities. First, there's the traditional Roth IRA, which is the one we've been talking about. It's straightforward and works for anyone who meets the income and contribution limits. Next is the backdoor Roth IRA, which is perfect for high earners who don't qualify for a traditional Roth IRA. Here's how it works. You contribute money to a traditional IRA first, and then convert it into a Roth IRA. This backdoor strategy gets around the income limits, but keep in mind, there can be some tax consequences when you do this. That's why it's a good idea to talk to a tax professional before making a move. Finally, there's the spousal Roth IRA, which is designed for families where one spouse earns little or no income. In this case, the working spouse can contribute to a Roth IRA on behalf of the non-working spouse, as long as the total household income is high enough to cover both contributions. It's a great way to maximize your family's retirement savings. What can you invest in with a Roth IRA? So if you've decided which Roth IRA you're going to go for, then you need to know what makes it so powerful, which is the wide range of investment options available, allowing you to tailor your portfolio to match your goals and risk tolerance. The most common investments in a Roth IRA include stocks. These let you own a piece of a company and often have the highest potential for long-term growth. Bonds. These are like loans to a company or government and offer steady, lower-risk returns. Mutual funds. These are collections of stocks and bonds which help spread out the risk. And lastly, ETFs, or exchange-traded funds. Similar to mutual funds, but often cheaper to manage and more flexible because they're traded like stocks. To understand this, let's go to John, who's in his mid-20s and a professional earning $250,000 annually, which places him above the income limits for direct Roth IRA contributions. His wife, Sarah, works part-time and earns $20,000 per year. Together, they decide to create a comprehensive retirement strategy that uses a combination of traditional Roth IRA, backdoor Roth IRA, and spousal Roth IRA contributions to maximize their long-term savings. Because John's income exceeds the limit for direct Roth IRA contributions, he uses the backdoor Roth IRA method. Each year, he contributes $6,500 to a traditional IRA and immediately converts it into a Roth IRA, effectively bypassing the income restrictions while still taking advantage of the tax-free growth offered by a Roth IRA. His wife, on the other hand, is eligible for direct contributions to a Roth IRA. John contributes $7,000 annually to a spousal Roth IRA in his wife's name, ensuring the couple makes the most of her retirement savings opportunities. Over the next 20 years, John and his wife consistently contribute a combined $13,500 annually to their Roth IRAs, which allows them to accumulate significant savings. With an average annual return of 7%, their contributions of $270,000 would grow to an impressive $497,000, all of which is completely tax-free in retirement. This includes their initial contributions and approximately $227,000 in investment growth. Now that you understand how a Roth IRA works, its different types, and what you can invest in, it's time to explore another heavy hitter in the retirement savings world, the 401k. A 401k is a retirement savings plan offered by your employer. It allows you to save a portion of your paycheck before taxes are taken out. This means you lower your taxable income for the year, potentially reducing the amount you owe in taxes. Which means, unlike the Roth IRA where you can't deduct contributions on your tax return, in a 401k, you can. The money you contribute goes directly into your 401k account, where it's invested in options like mutual funds, stocks, or bonds. Over time, these investments can grow, creating a significant retirement nest egg. Here's an example. Imagine you earn $50,000 per year. You will fall in the 22% tax bracket, but if you decide to contribute 10% of your salary to your 401k, that's $5,000 per year going straight into your retirement account. Since the money is pre-tax, your taxable income is reduced to $45,000, which means you now fall in only a 12% tax bracket. Think of it as a 12% extra tax that you would be paying, now ending up saved and invested. Plus, the contributions and any investment growth remain tax-deferred until you withdraw them in retirement. There are two main types of 401k plans, the traditional 401k and the Roth 401k. While both help you save for retirement, they differ in how taxes are handled. First, the traditional 401k. Here, contributions are made with pre-tax dollars, which reduces your taxable income in the year you contribute. With the Roth 401k, contributions are made with after-tax dollars, meaning you don't get a tax break up front. The major advantage is that with all withdrawals in retirement later on, including earnings, are completely tax-free. This makes the Roth 401k a great option for someone who expects to be in a higher tax bracket when they retire. It's kind of similar to a Roth IRA, but here there's a big plus, and that is employer matching. With 401ks, employers often match a portion of the contributions you make to your 401k, effectively giving you free money for your retirement. Here's how it works. Let's say your employer offers a 50% match on contributions up to 6% of your salary. So if you earn $50,000 per year and contribute 6% or $3,000, your employer will add an extra $1,500 to your account. That's a 50% return on your money right away. Employer matching is one of the easiest ways to supercharge your retirement savings. Financial experts often recommend contributing at least enough to get the full employer match. Otherwise, you're just leaving money on the table. But it isn't that easy. There are rules in 401k too. It has a contribution limit. As of 2025, you can contribute up to $23,500 per year if you're under the age of 50. If you're 50 or older, you can contribute an additional $7,500 as a catch-up contribution, bringing your total to $31,000 annually. Also, your employer's contributions don't count toward your personal limit. Employers can contribute up to an additional $46,500 for a combined total of $70,000 or $77,500 if you include catch-up contributions. This means your account can grow even faster if your employer is generous with their contributions. These higher limits make 401k an excellent choice if you want to save aggressively for retirement. Now, where does your money go when you contribute to a 401k? The investment options available depend on the plan offered by your employer, but they typically include mutual funds, target date funds. These funds automatically adjust their mix of stocks and bonds based on your expected retirement date. For example, if you plan to retire in 2050, a 2050 target date fund will start with more stocks for growth and gradually shift to bonds as you near retirement. Index funds. These aim to match the performance of a specific market index, like the S&P 500. They're known for their low fees and reliable long-term returns. Now that you've got a solid understanding of how a 401k works, its benefits, investment options, and the power of employer matching, it's time to compare it directly to a Roth IRA. And remember, in the end, I will show you which retirement option can save you an extra $100,000. But before that, let's compare them. When deciding between a Roth IRA and a 401k for your retirement savings, it's important to understand the differences in flexibility, accessibility, and tax savings over time. Each account serves a unique purpose and is tailored to different financial situations. Let's compare these two accounts to see how they stack up when it comes to your money. As I said earlier, the most significant difference between a Roth IRA and a 401k lies in how taxes are handled. To understand this, let's use a side-by-side example. Suppose you contribute $5,000 annually for 20 years with an average annual return of 8%. In a traditional 401k, you contribute pre-tax dollars, which reduces your taxable income now. If you're in the 22% tax bracket, this saves you $1,100 in taxes each year. After 20 years, your account grows to about $247,000. However, when you withdraw the money in retirement, you will pay taxes on the full amount. If your tax rate remains at 22%, you'll owe approximately $54,340 in taxes, leaving you with $192,660. Now compare that to a Roth IRA where contributions are made with after-tax dollars. If you're in the same 22% tax bracket, contributing $5,000 actually costs $6,410 up front, $5,000 for the IRA plus $1,410 in taxes. After 20 years, with the same 8% annual return, your account grows to $247,000. Since withdrawals from a Roth IRA are tax-free, you keep the entire amount, giving you $247,000 compared to the $192,660 from the 401k. But what if you face an emergency before retirement and you need access to this money? Let's see how much flexibility each account offers when you need that access from your savings unexpectedly. The Roth IRA is incredibly flexible, and here's why. You can withdraw your contributions anytime, tax-free and penalty-free. That's because you already paid taxes on the money you put in. This makes a Roth IRA a great backup plan for emergencies or unexpected expenses. But earnings are a different story. Earnings are the money your investments make over time, and withdrawing them comes with some rules. Your account must be at least 5 years old. You must be at least 59 and a half years old or meet certain expectations, like purchasing your first home or covering medical expenses. If these conditions aren't met, early withdrawals of earnings may be subject to a 10% penalty and income taxes. Another benefit is that Roth IRAs don't require required minimum distributions, or RMDs. Unlike other retirement accounts, you're not forced to start withdrawing money at age 73. This allows your investments to grow tax-free for as long as you desire, making the Roth IRA an excellent option for those who may not need their savings immediately or want to pass them on to their heirs. Now let's flip to the other side. A 401k is generally less flexible when it comes to accessing your funds before retirement. Early withdrawals before age 59 and a half are usually subject to a 10% penalty and income taxes. However, some exceptions allow penalty-free withdrawals, such as permanent disability, medical expenses exceeding a certain percentage of income, or special financial hardships. One unique feature of a 401k is the ability to take out loans. Many plans allow you to borrow up to 50% of your vested balance, or $50,000, whichever is less. You repay that loan with interest, but the interest goes back into your account. While this can be helpful in emergencies, there are risks here. Like, if you leave your job before repaying the loan, it becomes a taxable withdrawal and penalties may apply. Unlike a Roth IRA, a 401k does require RMDs starting at age 73. This can force you to withdraw money and pay taxes on it even if you don't need it, potentially reducing the account's long-term growth. When it comes to retirement, both accounts are effective tools, but their ease of use depends on your goals and financial situation. Roth IRA is best for flexibility, long-term tax-free growth, and avoiding RMDs. It's ideal for those who value control over their investments and want the option to access contributions penalty-free. On the other hand, 401k is best for maximizing employer matching, higher contribution limits, and immediate tax savings. It's ideal for those who want to save aggressively and benefit from structured, employer-sponsored plans. So now let's address the ultimate question: which account truly stands out as the better choice? Investing $100,000 is an important decision, especially when choosing between a Roth IRA and a 401k. Both accounts offer unique benefits, and understanding how they perform with such a large investment can help you make an informed choice. And in the end, you have to choose the better option for you. To do that, we have John with his $100,000 ready to be invested in both the accounts. Additionally, John's employer also offers a 50% match on his 401k contributions, up to 6% of his salary. For this example, we will assume that both accounts will give an 8% average annual return over 30 years. The retirement tax bracket is 22%. This scenario captures the real-life complexity of investing by combining tax considerations, employer matching, and growth over time. Let's see how John's decision plays out over 30 years. First, let's say John contributes $100,000 to a Roth IRA, where contributions are made with after-tax dollars. Because the Roth IRA allows for tax-free growth and withdrawals, every dollar he earns in investment returns will be tax-free in retirement. Assuming an average annual return of 8%, John's $100,000 would grow to approximately $1,006,266 by the end of 30 years. This includes all investment growth, and because withdrawals from a Roth IRA are tax-free, John keeps the entire amount. The flexibility and tax-free growth make this a powerful choice for retirement savings. For 401k with employer match, John's $100,000 grows to $1,373,303 before taxes. The employer match of $3,000 annually adds $90,000 over 30 years. With growth, the employer match contributes an additional $277,038. The total 401k balance is $614,000 before taxes, after accounting for a 20% tax rate during retirement John's 401k leaves him with approximately $1,098,643. Now let's look at the 401k. John contributes the same $100,000 to a traditional 401k where contributions are made with pre-tax dollars. His employer offers a 50% match on contributions up to 6% of his salary. Assuming John's salary allows him to take full advantage of this match, his employer will contribute an additional $3,000 annually for 30 years, totaling $90,000 in employer contributions. With the same 8% average annual return, John's $100,000 contribution combined with the $90,000 employer match will grow significantly over 30 years. His account will reach approximately $1,373,303. However, because this is a traditional 401k, all withdrawals and retirements are subject to taxes. Assuming John's retirement tax bracket is 22%, he will owe approximately $274,661 in taxes on the total balance. This leaves John with a final net balance of $1,098,643. If John had chose only one account, the Roth IRA would likely be the better option for its tax-free growth, withdrawal flexibility, and lack of required minimum distributions. Without RMDs at age 73, John's money can still grow tax-free for as long as needed, making it an excellent option for long-term savings and passing wealth on to heirs. However, the 401k is still incredibly valuable due to employer matching, making it an essential part of a balanced retirement strategy. If John's employer matching was more than $3,000, the end result would have been so much different. So that's the final verdict. 401k is the winner, but based on the numbers and assuming you're taking your money out after 30 years. Remember that every financial situation is different. This is not personalized financial advice, so always do your own research and consult with a financial advisor to make the best decision for your needs. That wraps up our journey through the best dividend lessons of the year so far. I hope this compilation gave you not just information, but real clarity and confidence to start building your own income stream. So keep investing, keep learning, and let those dividends start working for you. Thanks for being here, and I'll see you on the next one.